Property. Raspberry Pi in focus, revenues up, no change to guidance though. Commerzbank certainly in focus once again. Yesterday we saw weaker trading for Commerzbank. It looks less likely they'll get a deal done with UniCredit. Well, if UniCredit is going by the signals they're getting from the German government at least, but UniCredit is positioned to own 21% of this bank should it wish to do so. Guy?
Are European equities looking east or are they looking west? That's the question we're about to try and answer as we get to the open. Here we go. It is time for the opening trade. Let's look at the numbers. We're expecting, I think, a more positive picture maybe to emerge. But the FTSE is an interesting question, and I think it's struggling at the moment to get a clear sense of direction, not really jumping upwards at the moment to the degree that maybe other European markets may. So you've already got the IBEX up by 0.5%. The FTSE's now playing a little bit of catch-up. The 600 is up by 0.4%. I'm waiting to see what the CAC does. How do luxury stocks deliver on the back of what we're seeing out of China? How do German automakers deliver on the back of what we're seeing out of China as well? It's a key core market for them. So we'll wait for the CAC to open. There you go. It is outperforming by some significant margin this morning, up by 1.34%. The FTSE 100 is a laggard. We'll wait and see how the DAX opens in a moment. Kriti, what is happening below the surface?
Well, let's start with just some of the winners here. And you can kind of tell and make up your mind in terms of that French index outperformance. A lot of it is coming from the luxury space, a clear China read through, Anna, that we're seeing. But even it's showing up in the mining space as well. If you look at the FTSE 100, your biggest index contributors this morning are Rio Tinto, are Glencore, and then followed by a slew of banking names as well. So it really speaks to this idea of risk-on sentiment. Largely, it seems coming out of China.
Yeah, risk-on certainly. Basic resources, that sector as a whole up by 3.4%. And you see some of the names in the mix that would benefit from higher iron ore prices, higher commodity prices more broadly. We see Antofagasta higher, Rio Tinto higher, Glencore, ArcelorMittal. And we saw iron ore prices through the China session up by 5.8%. So this is quite a substantial move. Oil prices also up by 1.2% on Brent. We're at 74.82. Yes, there's some geopolitical tension in there, but colleagues do seem to be attributing this more to the China move. And so we certainly see that read across. CSI 300, as you pointed out, Guy, closing up by 4.3%, which is not a small move on that market, which is at a 5-year low recently.
The China trade is just written across the market this morning, isn't it? We have decided we are looking east rather than west. This has nothing to do with what's happened yesterday in the States. This is all to do with what the catch-up trade could look like. Luxury names are outperforming, but as we talked to Mark Cudmore a little bit earlier on, Chrissy, are we going to see this translating into a better consumer performance out of China? That's the key question for names like Kering and LVMH.
Well, we certainly will, and we should still mention the FTSE is underperforming, so we are going to keep an eye on that one as well. As we talk more about the cross-asset story, I want to quickly mention that we are getting headlines coming out of the EU Commission. They are clearing Swisscom's acquisition, of Vodafone Italia. This is a big deal because one of the concerns, one of the pushback from the Italian government was regarding Telecom Italia, which of course the government has a stake in. It has to do with what rates the Italian consumer faces. So the fact that the EU Commission is giving it a go-ahead is actually a good news in terms of that cross-border consolidation, perhaps outside of the banking sector. We're going to keep you apprised of that. Vodafone shares higher by 0.4% in London. Let's go back to the cross-asset story. Michael Snade, head of cross-asset and macro-quantitative strategy over at BNP Paribas Markets 360, joins us around the table. You picked a good day to do so. Good morning. It's almost like you planned it. Walk us through this take. I think one of the concerns this morning is it all looks great right now. Is this a knee-jerk reaction that doesn't have the legs to last?
So I think we have to take some context and some expectations into consideration. And I think once we do that, actually the outlook does look quite bullish. I think it supports the price action that we're seeing this morning. So we saw that heading into this, last week heading into FOMC, investor sentiment actually looked pretty subdued. So some of the core metrics we run to try to pick up investor sentiment said that investors were still trading in a risk-averse manner. That's despite the S&P being at very high levels. And that has given, I think, a bit of a base for risk to rally over the last week and probably rally after this event. Then on China itself, whilst there was building expectations over the last week that something will be delivered, what we've had announced, we think surpasses those expectations. So again, fuel for fire for this rally.
But we've heard this story before, haven't we, out of China, these rounds of stimulus? No, we haven't heard it all at once and in every possible way. Can they best it, or is this kind of the last attempt from China to really stem some of the losses in the housing market and the stock market? And the reason I ask that is if this is that last attempt and it doesn't last, do you start to see even more pain in Asia?
Yeah, so I think what's really key about this announcement is the signaling effect, in that for the last 6 months it's felt that there's been a need for stimulus to be delivered. Economists have continued to revise down their expectations. The data overall has been soft, but we've not seen that policy response. And that's because policy has been focused more on helping to rebalance the economy, not adding too much debt to the economy. Now that we've had this kind of joint announcement, it shows that there is more of a willingness to accept that the downward trend that we've had in economic activity in China cannot continue, and the policymakers need to step in and deliver more. So I think that signaling is really powerful.
Michael, let me just mention, I mentioned this earlier on in the programme, but just to reiterate, traders lifting their betting around the ECB and the extent of the easing we're going to see from the ECB, seeing a 50% chance of an October cut. So that's the sort of backstory to my question, because I wanted to pivot the conversation to Europe. Europe obviously has a lot at stake when it comes to the Chinese growth story. And you're talking about how actually Europe can just bump around the bottom for quite a long time. It doesn't necessarily have to tip really into a recession. Explain that difference for us, because you think differently about the US and Europe right now.
Yeah, I think there's a really interesting kind of compare and contrast between the US and its slowdown and Europe. The US, we titled our global outlook for this quarter, Cutting It Fine, because we really think that in the US you can be on a bit of a knife edge in that there's potential non-linearities. If you get softening data, a softening labour market, you can cause confidence to weaken, that then causes spending to reduce, and very quickly you can kind of snowball into a much deeper slowdown. We don't think that's going to happen, but it's a risk there on the left-hand tail. In Europe, we deem the situation to be a little bit different because, one, potential growth is much lower, so you can be at zero growth without it really being a substantial slowdown. And then we also see the non-linearities as being more limited. And that's due to some of the more structural rigidities, the fact that the labour market is more rigid in Europe.
Yes.
The savings rate is higher. So this means you don't necessarily get on responsive soft economic news, a knee-jerk reaction from the economy that then causes those non-linearities.
Okay, so you don't get the non-linearities, to use your language then, here in Europe. Does that, plus the fact that we're seeing this stimulus package in China, turn you more positive on Europe?
Yeah, so I think, the last 24 hours we've had, real mix in that yesterday the data, it did look very poor. It's not enough
Out of Europe, yes.
Out of Europe, yes. It's not enough to secure that October rate cut, but it certainly really draws attention to the survey data that we get with the IFO today, further surveys later this week, inflation data into this week, early next week. In terms of whether or not this China news can impact that story, we're seeing it, of course, in the European stocks. It's changing the sentiment, but it takes time for the economic impacts of stimulus in China to feed through to support for Europe. So that China stimulus news is probably not enough to take off those downside risks to the European economy just yet.
As we approach the end of the month, bonds and equities are basically neck and neck. What does that tell me about what I want to be doing with my portfolio? Is that the right mix? Do I want to have a balanced portfolio at the moment? Do I want to be risk on or risk off?
So we think in the short term you want to be risk on. We think that investor sentiment can improve. But that doesn't mean that you should necessarily be diluting your bond holdings and increasing your equity holdings, because there are still risks out there. And also, against this backdrop of low inflation, central banks being able to respond to what is a soft landing narrative, this is a good backdrop for bonds. So we think that this is a good time for real money investors to be positioned in both bonds and equities. If we think about the risks that might ensue, We think that there is still risks that you get a deeper slowdown. We're really watching, particularly the US labor market.
Yep.
If that was to evolve, then it means your bond allocation is probably going to provide you with protection, which is quite a rarity. And if we look back over the last couple of years, bonds and equities, they've not provided the diversification. And as a result, what we've tended to recommend is that investors need to look at more derivative products or more systematic products to provide that diversification. Actually, investors at the moment can take some comfort that there is that bond equity diversification.
Do I want to focus on diversification or outperformance?
So, if we think about what's coming up, the US election, I think that is going to really focus on diversification, because we think that as we head into the US election, there is going to be an increased period of uncertainty. So we're risk on now, but in October, we're expecting vol is going to rise. You're going to be pricing in more of that election risk premium. It's probably going to create some volatility in equity markets. So diversification, we think, is still going to be quite key for investors.
Great to see you. Thanks for stopping by to see us and join us around the table. Michael Snade, Head of Cross-Asset and Macro Quantitative Strategy at BNP Paribas Markets 360. Thank you very much indeed. Quick look at the Core 6, just to figure out exactly how some of those luxury names are performing this morning. As you can see, significant outperformance coming through from names like LVMH. Ferrari, interestingly enough, not doing quite so well. Some of the tech names are doing okay, but you are certainly seeing an underperformance of the defensives. Is this the time to turn back to cyclicals? Maybe it feels like today, but maybe a different story going forward. We'll see how long this China story lasts. Let's get some single stock movers. Here's Joe Easter.
So luxury is a big focus this morning, Guy, and we're seeing gains across these screens this morning. We've got Swatch, Moncler, Burberry, LVMH among the biggest gainers. Now, bear in mind, on a normal day, these stocks would probably be lower because we've had UBS cutting price targets and ratings on these stocks, recommending selling Swatch because of the recent China weakness, downgrading Moncler, a price target, a street low cut on Burberry as well. So I would expect those stocks to be lower if it wasn't for that Chinese news really boosting all of these cyclical and luxury goods spaces as well. But the other area really moving today is the metal stocks leading the gains across European equities today. The best performer was Norsk Hydro. Looks like Anglo-American coming up above that now. Anto, ArcelorMittal, massive gains in those shares, given the jump in some of the base metal prices that we saw overnight on that news of the Chinese stimulus package. Then we're also looking at some share sales in the UK. We mentioned Dunelm, the chairman, offloading a big stake in that today at a decent discount. And we had another placing in Admiral as well. That one looking unchanged at the moment, holding up. That was an employee trust selling some shares in that one. Then in terms of earnings, some big movers today as well. Now we've got Smiths Group, the industrial firm, the engineer in the UK, supplying into communications and energy, a bit of a weak one there. Raspberry Pi, the debut earnings report from them. That's a computer company that listed recently, pretty strong. Earnings are up 60% for the company, but Card Factory absolutely slammed on a profit warning. Now, this is related to the national living wage regulation coming in. They're talking about that in their statement, saying that's going to hit their profit margin. So that stock absolutely slammed in London at the moment. And TUI, now this one is saying that the winter bookings are stronger than they've ever been, according to the company there. So that's a positive one. Trading in both the UK and Germany. TUI getting a bit of a boost today. Then finally, we will look at a couple of rating changes that we haven't done yet. AMS Osram, take a look at this one, up almost 10%. This is a semiconductor firm over in Switzerland, semiconductor sensors, that kind of thing. 70% upside to the price target at UBS, which upgrades the stock to buy today, and we're up almost 10% for that one. And then one stock going the other way is Saab. This is in defense. Bank of America downgrading, saying that the rally in some of the defense stocks may have gone too far, and that one is reacting a bit of rare red on the screens this morning, down 5% for Saab as Bank of America downgrades the stock this morning.
Joe, thanks very much. Joe Easton from our equities team. With some of the impact that we're seeing from this Chinese news flow, we've been covering it since the top of the programme. A suite of policy measures coming not just from the PBOC, but from stocks regulators and other regulators in China, pushing up commodity prices, and investors very evidently moving then from fixed income into equities as a result of this. We saw that during the Chinese session. It seems to be something that's taking place in Europe as well.
Are we also going to see this rotation out of defensives, which are outperformed over the last few weeks, into cyclicals? Some evidence of that this morning as well.
Some slight evidence, but I gotta make a fun fact here. David Inglis, our colleague over out of Asia, points out that even with this rally, we are at levels half of what we were at 4 years ago. He said to get back to these levels at an annual kind of rate that we've seen, you still have 4 years to go. He talks about that sustainability issue.
Yeah, on Chinese stocks, we were at 5-year lows before that. I mean, partly that's what prompts some of the policy.
But is this the moment to buy?
Yeah.
If you've got 4 years to get back, it's a 4-year ride all the way back up to those highs.
To your point earlier, we've been here before. We've had plenty of policy initiatives before from China, and then we've been left asking, is this really the turning point? And it just because something's cheap hasn't necessarily been. And your other point, I think, is really valid. You know, a lot of these measures directed at stocks, how much is the wealth effect from that, and at property, how much of that is sufficient to make a difference to consumers? Obviously, investors are betting that it will today, certainly on the luxury end of things.
You could argue a better performing stock market, the translation into some of the high-end luxury names probably is a more logical conclusion. We've always seen this kind of crypto does well. You see luxury watch sales doing well. That kind of feels like a fairly solid connection, and maybe that's why names like Hermes are doing so well this morning.
And you mentioned the kind of policy story and the economic fundamentals. We should mention they're prior to all of this kind of conundrum and damage that you saw in the Chinese market as well. Investors are already pivoting away from China to the likes of India, South Korea, etc., and this just kind of added to the pain.
Okay, what are we going to do next? Let's talk about hedging your bets. We're going to head back to the Wembley Stadium for more hedge fund talk. Mike Asness, CIO at AQR, is going to be joining Danny Berger at Wembley. That conversation next. This is Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back to the opening trade. We're 18 minutes into today's session. Green on the screen across the equities picture. Outperformance over in France. A lot going on in terms of that China read-through. But now let's get back to the hedge fund world. At Kepler's annual gathering at Wembley Stadium, Bloomberg's Danny Berger there for us with an exclusive interview. Danny.
Hey, Critty, I'm really pleased to say that I'm here with AQR's Cliff Asmus. Cliff, thank you so much for joining this morning.
Thanks for having me.
We have to start with your paper that caused quite a bit of a stir. Let me just read the title for our audience. The Less Efficient Market Hypothesis. Quite the claim for someone who studied under arguably the godfather, Eugene Fama, of the EMH. So what did you see that led you to believe this market is less efficient?
Sure. Well, efficient markets in general are this idea that prices, in some rational sense, reflect all information. That's the extreme version of that hypothesis. Gene tells the class, like third week of class, markets are assuredly not perfectly efficient. And you get a gasp because it's the University of Chicago. Everywhere else in the world, they just go, yeah, we know that. But in Gene's class, that's a gasp. So it begs the question, once you accept they're not perfect, how imperfect and does that change through time? And I'm very clear about this in the paper. A lot of this is op-ed, it's my life experience in this business. But over my career, at the very beginning of my career, when we started AQR, 18 of our first 19 months were the blow-off top of the dot-com bubble. And we did a lot of things back then. We were losing a lot of money. That was the bad part. It wasn't statistically like beyond shocking, but it's not pleasant to happen in your first year and a half. And it turned out that the prices between cheap and expensive stocks, in general, using a bunch of valuation measures, maybe they vary between 6 times more expensive to 3 times more expensive, the expensive stocks. They had shot up to like 13, and they'd never been close. There's 50 years of this and then this. So then you spend a lot of time saying, is there some way we're wrong? Is there a reason this is rational? And if you conclude no, you stick with it. Then if someone had said to me at that point, is this going to happen again in your career? I hopefully would never say never. No one in our field, your field, my field, should ever say never about anything financial. But I think I would have said, oh, yeah, probably not, almost definitely not. Because it hadn't happened in 50 years. My career's not going to be another 50 years. I wish it were, but it's not going to be. And the question in your career presupposes you're still here, and you're not the only one. And you guys are probably in charge. So how's this going to happen again? And then even before COVID, it was getting there. But COVID took that same differential and blew it out of the water.
But Cliff, why can't I argue it'll play out the same as last time? That spreads will come back down, value will work again, and it's just we're in another one of these periods.
That's exactly what we do argue. So you are totally permitted to argue that. But the bigger question I'm trying to answer is I see this as a sign of the market getting less efficient about pricing. And in principle, we all think things should get more efficient over time. Technology marches on, data's more available, things that were available at a lag are available instantly now. But I think most of those things go to speed, not to accurate pricing. Yeah, things get in prices faster. But I think there's strong evidence, not just these two things, but these are the two major ones I experienced, that the crazy periods are getting crazier and lasting longer. So the next question I ask in the paper, and this is very speculative, I admit, is why? Why? And there are probably other great ones, but I focus on 3, and I'll say them really fast.
Sure.
The first is the rise of passive. That's everyone's favorite. Passive has broken the market. I think that is probably part of it. No one knows how many people can actually be passive without breaking the market, but we know it's not 100%. That's a weird world where nobody is thinking about whether NVIDIA is worth more than a candy store.
Yeah.
So the idea that there would be less could weaken the tether to reality.
I want to let you get to the other two,
sure,
because I find them really interesting. But just in terms of that, especially when we're talking about NVIDIA, and this being a crazy period.
You know quants know nothing about individual stocks, right?
Of course, you know nothing about a single stock. I'm very aware of that. How crazy is this period?
We're still, and I won't talk about NVIDIA in particular, but when it comes to the spread between cheap and expensive stocks, we were at a new 100th percentile in COVID. I jokingly call it the 120th percentile, which from my math friends listening to you, there is no such thing. It's just the new 100th. But it was about 20% above the prior 100th. We're back down to about the 80th percentile spread versus history. We still have a little bit of a tilt on, but far smaller than when it was 120. So I would say things are still out of whack. but it's not an arbitrage you can drive a truck through
right
now. But so I think passive is part of it,
right.
But it's very hard to know how much. The second one I'll do beyond quick. Post-GFC, 10, 15 years of super low interest rates, I don't think justifies these spreads, and we've written a lot about that. But in a very non-technical sense, may that drive investors mad and to do some crazy things? Yes. That's all I'll say about that. My third and favorite hypothesis, because it's so counterintuitive, is I started out saying technology might make things faster but not more accurate. It might, and in fact, I would argue probably does, contribute to the less accurate pricing. And in particular, I'm talking about the milieu of instant information, free trading, certainly social media. The dot-com bubble was the first go-around of kind of proto-social media, where you're a little too young for this one, but message boards were very hot. People were all discussing their favorite e-toys and drcoop.coms, and if markets are efficient to some degree, not perfect, the wisdom of crowds, the famous idea that a crowd can be more wise than the average component of the crowd, is a huge part of it.
How much of your Twitter interactions color this? Because you're not afraid to talk to, I just, you know, when you're talking to people who you don't agree with online, does some of that color it saying, maybe this crowd isn't so wise?
I hope not. But may it sneak in? I would have to admit it might sneak in. But if a wise crowd is the goal in a market, have we ever had a vehicle better than social media for turning a wise crowd into a dangerous mob? And I'm not going to get political, except I'm not going to choose a political side. But if our politics are not a great example of this, I mean, there was a point 20 years ago where we had utopian views with that social media would make us all like each other more. I don't think I need to convince any of your viewers that that has not happened. And I think a lot of the same has creeped into markets. It's unfair to choose the most crazy example, but a poster child, not a proof, are the U.S. meme stocks. They are the most extreme example of what I'm talking about.
Right.
Crazy valuations driven by social media. But life is not just them and everyone else. It's a point on a spectrum. So I do think markets have gotten somewhat less efficient.
Right.
I think the final interesting question is, what does that mean for a rational style of investing?
Can I ask, because you also
please.
point out in your paper that it's a problem for society.
Yeah.
Why is it a problem for society?
Well, if you're actually going to read the paper, it's going to make this all take longer. You know that, right? It's a problem for society, and I think I'll be a cheerleader for our industry.
Yeah,
I don't
we
think
got to be quick here, Cliff. Only 30 seconds.
I don't know if enough people think about it this way, but rational prices are very important to a free enterprise society.
Yeah.
When prices are wildly irrational, prices are how we allocate resources.
Yeah.
And we do it in a very unproductive way if companies that are not very productive and are speculative and pie in the sky are getting all the money.
Yeah.
So it matters. And let me finish with one thought. What does it mean? Well, if markets are somewhat, I don't say they're terrible, less efficient, deviations from fair value will be...
We got to end it there. I'm so sorry. We're
deviations
coming up against
from fair value will be bigger, last
Perfect.
longer, but you'll make more money from them.
Cliff, you nailed it. Thanks so much. That was Cliff Asness of AQR over here at the Kepler Conference. This is the Opening Trade.
Names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that Their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Minutes since the opening trade, European equities on the front foot. It is China that is lifting us up today. Luxury stocks in particular are outperforming. You could see that with the French markets, which is up by 1.1% right now. Let's turn from the luxury sector to what is happening in the banking space. Diplomatic tensions between Germany and Italy bursting into the open. This after UniCredit has upped its stake to become Commerzbank's largest shareholder. The Chancellor of Germany, Olaf Scholz, calling the Italian move, quote, unfriendly. Let's get more on this story. Oliver Crook is standing by in Berlin. This moved very quickly, Ollie, and Orcell's approach certainly has caught a lot of people in Berlin on the hop. Now what?
Yeah, Guy, listen, I just want to run through this because, again, this has only been 10 trading days. This was on nobody's radar back on September the 10th here. This is when Orcell was in the market, privately sort of buying this stake, and then in anticipation of the fact that the German government was going to offload that 4.5% stake, which he went in with a fill or kill order and got the full stake. Then suddenly on the 11th, you know, he's got a 9% percentage of the company. There is total confusion both in Berlin, over at Commerzbank. Everything is sort of thrown up in the air. There's a lot of questions about whether Deutsche Bank is going to get involved in some way, be able to block this merger. Then things go quiet for a couple of days. Then going into the weekend, we get the finance ministry in Germany saying basically we're not really in favor of this, still being very diplomatic about it, being a bit quiet about it. So on Monday, you open up, come straight down, only to discover that Orcell has, in the meantime, moved additionally for another 11% stake, taking it to 21% stake in the bank. This would mean that he would be the greatest shareholder. We should say that it's right now only in derivatives because he's not allowed to realize that, that possession of the stake because he doesn't have the permission yet from the regulators to go over 9.9%. But then this has forced Olaf Scholz to come out at the UNGA. He's there to be dealing with sort of high diplomatic issues, the war in Ukraine, dealing with leaders there, to come out and deal with this Commerzbank situation, saying that unfriendly attacks, hostile takeovers are not a good thing for banks. We do not consider this to be an appropriate course of action. So the chancellor just sort of being blown off course here, but really throwing everything in disarray here, guys. And I think it's probably safe to say there's something smacks a little bit of sort of barbarian at the gates here that we probably have not heard the last from Andrea Orcell on this.
So Ollie, that was the German side of things. Talk to us about perhaps the response from Italy.
Yeah, so listen, there are so many different dimensions to the story. It's worth just going through sort of all of them in sort of sequence. There's the domestic question, right? The fact that the government itself is probing its own stake sale, which is quite an embarrassment. The fact that we haven't actually even heard from the Commerzbank shareholders. Shareholders tend to like it when the value of their stock goes up. That is exactly what this Unicredit bid has been doing. We have not really heard from them. The Commerzbank is assembling with some of its regulatory board, and they're going to discuss it over the next couple of days. The unions have been out. They've been lobbying the government. They're going to have a press conference at 1 o'clock. And again, the German government is looking at what actually happened here. For the political story within Germany, where you have a sort of surge of nationalism coming up, you also have the opposition leader, Friedrich Merz of the CDU, who's really using this as a sort of a way of saying that the government is incompetent, has mismanaged the stake, that basically it's a disaster for the banking sector. And then, of course, the last is the international sort of dimension of this, where the Italians very unpleased, saying that when it's time to come to Italy and buy a company, it's no problem. But when it comes to going into Germany, suddenly it's no longer a free market.
Oliver, thank you very much. Bloomberg's Oliver Crook there with the latest on Germany. Apologies for the quality of the audio we were getting there. Let's continue this really important conversation, though. We're joined now by Jackie Inneker, CIO at Spring Investments. Really nice to talk to you, Jackie, and thank you for bringing us your take on this. I wonder if you can, not to talk too much about the individual personalities involved necessarily, but give us a sense of the style at which this approach was made, the way that Unicredit has gone about this. Do you think that's why we're seeing some of the pushback in Germany? Do you think that's helping or detracting from this M&A approach at the moment?
Yeah, I've got to say, I'm sorry, good morning, everybody. I've got to say it's kind of detracting. It seems to be a generally straightforward acquisition. I mean, it makes a lot of sense. You've heard a lot of this from the equity guys, I guess, less so from the credit guys. But certainly from a credit perspective, the news flow that's going on is really not affecting where bonds are trading. What you have in the credit markets, you've got about 90 billion of debt issued by Unicredit, 60 billion from Commerzbank. And what's happened over the last couple of weeks in terms of the most deeply subordinated debt market, which is what Spring focuses on, AT1s, you've had Commerzbank rise a couple of points. You've had Unicredit come down about 50 basis points. There's still a bit of clear water between the two. You know, there's some more compression to go. But the bottom line from the credit markets is that we like this. The compression has been upwards towards the top where Unicredit's trading. And so we definitely think it's good news, not so much detracted by the flow.
Right, okay. So, I mean, equity markets have been reacting to the likelihood of whether we get a takeover or not. And yesterday we saw the share price, of course, retreat on that news flow. So are bond markets assuming this happens then, Jackie? Is that what you're seeing at this really subordinated level?
Yeah, I mean, this is what we're seeing in the markets for sure. I think there's a couple of things here. First of all, you know, when Orchel says there's a huge potential here and we're going for it, everybody listens. You know, Commerzbank has been an M&A target, arguably, for a number of years. We've been here before, and it's one reason why, you know, we've had a big position in Commerzbank for so long. It's been unloved and trades cheap. But as soon as Unicredit comes back in and opens that, you know, that perspective to the market, that's not going to go away, no matter what happens with Unicredit now. Orchel has said he's going to be very patient. I understand that he's got stakes elsewhere where he's being patient. But I think if something happened that Unicredit had to pull away, I think there's a number of other banks who would be in the door, knocking, looking at it from a perspective of maybe less impact on the labour unions for Commerzbank. That would be, I presume, a lot more palatable in Germany.
Jackie, good morning. It's Guy. Does Unicredit trade as a German credit if it were to take over Commerzbank rather than Italian credit, or is that a distinction we don't need to make?
I think you don't need to make that. I mean, of course, they already own HVB, and they're very well diversified geographically already, yet it still has a little bit of a, you know, obviously it trades from its Italian nature. I mean, one thing I would say is that we don't really want to trade it as a German credit, because actually Unicredit right now has a lower rating than Commerzbank, and yet Unicredit trades better than Commerzbank. So actually we don't really want that German angle to it. So I think if this acquisition goes through, and then they'd make, you know, the size would be 1.3 trillion, in total assets. My gut feel is that, as the credit markets are showing you now, they trade up to where UniCredit was trading before. They don't meet in the middle. So I think it's good that it trades like a strong, diversified Italian bank.
In terms of what the other options are, there's some talk that maybe you could merge Commerzbank and HVB. There's all kinds of permutations that are being talked around that. Is a full takeover the only option that we should think about here?
Gosh, that's an interesting one. My guess is I think that's what Orchel wants to do. That's a hard one to answer. Honestly, what the credit markets are saying is that this is going to go through as a full acquisition if it happens. I think other permutations is not what Orchel's after. And again, he says he's going to be patient. He can wait on the sidelines for a very long time.
Jackie, it's Creedy in London. I want to pick up on that point you made about UniCredit not trading necessarily as a German debt instrument, because it's not the only company, or bank in Europe that's looking for that German exposure. BBVA has been making significant investments in Germany as well, arguably to its own detriment, considering Germany is largely considered as overbanked. It's also engaged in its own acquisition of its own with Banco Sabadell. Walk us through your take on that company and that credit.
Yeah, that's a great question. Obviously, this kind of underlines the strength of European banks right now. If you take a step back, and I don't think there's been a lot of focus on this, but European banks have been through the ringer with regulations for the last 15 years. They're overcapitalized, and that's me as a credit analyst. I love banks being hugely capitalized, but arguably they've got too much capital now. To put that into context, probably the average equity ratio was like 6% before the financial crisis. Now UniCredit's at 16%. It's far too much. The minimum requirement is closer to 10. So banks have a lot of firepower, and I think you'll see a lot more M&A coming, because I think we've reached peak capital. What do you do with it? Do you deploy it? Do you do what UniCredit's doing, what BBVA is doing, as you point out? Or do you buy back shares? Banks are still buying back shares. We had 25 billion in the first half, but banks are still overcapitalized. From BBVA's perspective, again, they're chasing Sabadell right now, and they're looking for more diversification outside of Spain, as well as becoming a larger bank in Spain, where I think they're struggling a little bit. But again, from a credit market perspective, what you've seen is that the credit markets love this BBVA potential Sabadell acquisition. Again, from a credit spread perspective, you've seen those two compress. Sabadell moving up to meet, the higher and better trade in BBVA.
Jackie, you made an interesting comment, which is the strength of European banks, and I couldn't agree with you more that the buybacks that you're seeing out of the banking industry, especially in Europe, are pretty eye-watering. Is it strength in European banking as a whole, or is it strength that we're seeing, or outperformance that we're seeing in peripheral Europe banks? Do you see that distinction?
Honestly, Chrissy, I would say the peripheral banks are generally better capitalized. Again, depending on how far you want to go, the Greek banks are some of the best capitalized banks now, much better than the French banks, for example. But of course, there was a lot more failures, or huge failures, through the crisis and the sovereign crisis thereafter. So they've been forced to massively recapitalize, reduce non-performing loans, get themselves in the best shape they can. I mean, again, at Spring, this is a big focus for us. The Greek banking sector is superb, and the economics are great. So I think it's nuanced, though. I think all the European banks have been through this 15 years of heavy, heavy regulations. Look at the share price action over most of that time. It's been horrendous, because if your capital's going up and up and up 2 to 3 times, of course your ROE is going to struggle. But for creditors, it's been fantastic. But I really think we are at peak capital now. Okay. And it's generally.
Jackie, do you think Orchel stops here? Is there a logic to continuing? Are there other banks that you think would fit into what he is building? And do you think this is a process that will happen relatively quickly? He seems to be a man in a hurry. I appreciate you saying that he's got time on his side at the moment, but he does seem to be moving relatively quickly. How far do you think his ambitions may go?
Well, you know what? He's got an absolute war chest in terms of capital. He's got far, far too much capital in that bank. And again, what's he going to do? Buy it all back? The ECB won't let him buy it back all at once. It's going to be a year's process of doing that. So if he sees targets that make a lot of sense, and he's been very clear, very consistent about what he's looking for, then yeah, he will add. I mean, this is a huge acquisition, so I'm sure this will take the whole time. Right now, I think it'd be crazy to say he's going to move to somebody else. But he also has, nearly a 10% stake in Alpha Bank in Greece. That was through the Romanian kind of acquisitions they did. So yeah, it has a number of fingers in a number of pies, and the firepower. I mean, this is how he can make this bold move. So, no, if this gets rebuffed, if it was to end tomorrow, which I absolutely don't think, there are plenty of other options, I think, for him to chase.
Jackie, you're clearly quite positive about the sector, but looking at the individual names that you like, they're all quite small. I wonder what draws you, what makes you think that it's now the right time for some of the smaller players? That's not about M&A, I don't think. What is it that draws you to them?
Actually, it's a mix. So, we can, we have this AT1 fund, we can go in, we can buy BNP, we can buy UBS, we can buy Lloyds. That's great. But I think really where you get the outperformance is in some of the smaller names. They're small, they have small bond issues, but they're some of the strongest banks in Europe. So, we like to focus on those. I mean, there's, Van Landsrot in Holland, it's a wealth manager, it's super, and it trades cheap. A few others that we like are actually, I would say, acquisition targets in years to come and are currently being turned around, like CCF, like the Volksbank, like OLB in Germany. These are all names we really like. And I think that's where, they're under-researched, they're small. Some of the very, very big funds can't look at these small names. That's where the opportunity is. Don't get me wrong, we do have the UBSs, the BNPs, but I think the outperformance is doing the analysis on the smaller names. And, as I mentioned, so many banks have so much capital, they'll be looking for acquisitions. They are. And the domestic acquisitions are clearly much, much easier than what UniCredit's doing.
Jackie, thank you. Thank you very much for joining us. Really good to get your perspective. Jackie Inaka,
Our developers can start building today with GPT-4o and making amazing AI applications, deploying them at scale. 4o is available at 2x faster, 50% cheaper, and 5 times higher rate limits compared to GPT-4 Turbo. But, as we bring these technologies into the world, it's quite challenging to figure out how to do so in a way that's both useful and also safe. And GPT-4o presents new challenges for us when it comes to safety, because we're dealing with real-time audio, real-time vision. And our team has been hard at work figuring out how to build in mitigations against misuse. We continue to work with different stakeholders out there, from government, media, entertainment, all industries, red teamers, civil society, to figure out how to best bring these technologies into the world. So over the next few weeks, we'll continue our iterative deployment to bring out all the capabilities to you. But today, I want to show you all these capabilities. So we'll do some live demos. I will bring on 2 of our research leads, Mark Chen and Barrett Zoff.
Hi, I'm Barrett.
Hey, I'm Mark. So one of the key capabilities we're really excited to share with you today is real-time conversational speech. Let's just get a demo fired up. So I'm taking out a phone. If you are wondering about this wire, it's so we have consistent internet. And if you see, there's this little icon on the bottom right of the ChatGPT app, and this will open up GPT-4o's audio capabilities. Hey, ChatGPT, I'm Mark. How are you?
Oh, Mark. I'm doing great. Thanks for asking. How about you?
Hey, so I'm on stage right now. I'm doing a live demo, and frankly, I'm feeling a little bit nervous. Can you help me calm my nerves a little bit?
Oh, you're doing a live demo right now? That's awesome. Just take a deep breath. And remember, you're the expert here.
I like that suggestion. Let me try a couple deep breaths. Can you give me feedback on my breaths? Okay, here I go.
Whoa, slow a bit there. Mark, you're not a vacuum cleaner. Breathe in for a count of 4.
Okay, let me try again. So I'm gonna breathe in deeply. And then breathe
And then
out.
for 4, and then exhale slowly.
Okay, I'll try again. Breathing in and breathe out.
That's it. How do you feel?
I feel a lot better. Thank you so much.
So Mark, you've been working on these capabilities for a while now. Can you tell us a bit how it's different from voice mode?
Right, so if you've used our voice mode experience before, you'll notice a couple key differences. First, you can now interrupt the model. You don't have to wait for it to finish your turn before you can start speaking, and you can just butt in whenever you want. Second, the model is real-time responsiveness. So that means that you don't have this awkward 2 to 3 second lag before you wait for the model to give a response. And finally, the model picks up on emotion, right? When I was breathing super hard there, it could tell, and it knew, hey, you might want to calm down a little bit. You're kind of running a little bit too fast. So, it really has that capability across the board to perceive your emotion. Not only that, though, the model is able to generate voice in a variety of different emotive styles. And it really has a wide dynamic range. So I'm going to fire up another demo for that. Yeah. Hey, ChatGPT, how are you doing?
I'm doing fantastic. Thanks for asking. How about you?
Pretty good.
What's up?
So my friend Barrett here, he's been having trouble sleeping lately. And I want you to tell him a bedtime story about robots and love.
Oh, a bedtime story about robots and love? I got you covered. Gather round, Barrett. Once upon a time, in a world not too different from ours, there was a robot named Byte. Byte was a curious robot, always exploring.
Started this story, but I want a little bit more emotion in your voice, a little bit more drama.
Got it. Let's add some drama. Once upon a time, in a world not too different from ours, there was a robot named Byte.
No, ChatGPT. I really want maximal emotion, like maximal expressiveness, much more than you were doing before.
Understood. Let's amplify the drama. Once upon a time, in a world not too different from ours, there was a robot.
Gasoline is about 40% cheaper in Nigeria than in Saudi Arabia, which I think it doesn't make sense. That is one. Number two, our price of gasoline is about 60% of the price of our neighboring countries, and we have very porous borders. So it is not sustainable. The amount of subsidies that were paid, government cannot afford those subsidies.
So do you need the government to take away the subsidies for your refinery to be viable?
Well, you see, we have a choice of either when we produce, we export, and when we produce, we sell locally. But we're a private company. And yes, it's true, we have to make a profit. We build something worth $20 billion, so definitely we have to make money. The removal of subsidy is totally dependent on the government, not on us. We cannot change, price. But I think, the government will have to, give up something for something, So I think at the end of the day, the subsidy will have to go.
Dangote Group founder and chairman and CEO Aliko Dangote speaking to our very own Francine Lacqua. Let's go to another story we're watching from around the world. Israel has launched airstrikes across southern Lebanon, killing nearly 500 people, marking one of the deadliest days of fighting in nearly 2 decades. Meanwhile, the United States says it's sending a small number of additional troops to the region, urging restraint as fears of an all-out war grow. Bloomberg Horizons anchor Jumana Bersechi joins us around the table. Jumana, a tragic situation in Lebanon. Of course, the concerns here are now around the prospects of a ground invasion on Lebanon. How seriously should we be taking that threat?
Well, let me just recap some of the events that happened in the last 24 hours, because it was the deadliest day for Lebanon since the 2006 Lebanon-Israel war that went on for over a month. There were a series of airstrikes, not just in southern Lebanon, but in Beirut suburbs and in East Bekaa, which is very close to the Syrian border as well. Israeli military say that they launched airstrikes on 1,300 military targets. But by the end of the day, the Lebanese Health Ministry put the total figure of nearly 500 deaths, including 58 women, 35 children, 1,650 people being wounded throughout the course of the day. So very, very high toll here. What we saw over the course of the evening and late in the afternoon is, in retaliation, Hezbollah also fired rockets into northern Israel, into Haifa. Sirens went off. Most of those rockets were intercepted. And this morning, more sirens have gone off as well. But there is no indication from either side that we are heading towards a de-escalation. If anything, the rhetoric from Israel and even from Lebanon, from Hezbollah themselves, and the fact that they have retaliated this morning and throughout the course of yesterday afternoon tells you that they don't want to be backing down, or don't want to be seen as backing down, even though, as we've been reporting, many of their senior military commanders and their senior fighters have been killed in the last week.
Why is the casualty count so high if these are military targets?
So Israeli military have said that they have been aiming for military targets. They have also said that the Hezbollah group have placed rocket launchers in people's private homes. The IDF also sent messages to many Lebanese residents over the course of the morning yesterday, warning people to leave their homes and to take those messages seriously, because an airstrike was coming. Now, the issue in Lebanon is there is no such thing as bomb shelters. There are not lots of places where people can go. A lot of panic and fear ensued. It was very difficult for people to move out of their homes. There are traffic jams for 3-4 hours from South Lebanon all the way up to Beirut. And the health ministry, the state-owned Lebanese TV network in the evening was saying that buried under the rubble were entire families. So the Lebanese ministry are saying that this isn't just military targets or military commandos have been hit, but entire families, women and children as well. From Israel's perspective, they say that they have given residents warning, and therefore they would have had ample time to move away.
Jemana, thank you very much. Bloomberg Horizons anchor Jemana Bassett in London this week, and able to give us an update on what is happening on the ground in Lebanon. Let us turn our attention back to what is driving markets this morning, and clearly the Chinese news flow has been front and center for what we're seeing. Asian equities had a very strong session. The Hong Kong market up by nearly 4%. The CSI 300 was up really strongly during the Asian session, and we do see that filtering through into the markets here in Europe. Basic resources, that sector up by more than 4.3% as iron ore prices and the like push higher as we see coordinated efforts to stimulate the economy over in China.
Yeah, this is an interesting one, because of course this is a sector that has actually been the underperformer lately. When we talked about even that brief rise that we saw in copper prices and then coming back down, it shows up in the luxury sector as well.
So you go to your GRI, you look at the sector story, you look at it over the last 3 months. Best three performing sectors: real estate, telecoms and retail. The defensive end of the market has done best. You look at what is the worst performing sector today: telecoms, utilities and real estate. The market's rotating out of the defensive names that it's been in over the last few months. As we start to maybe see this move back into luxury, is that going to be sustained?
Yeah.
Are we going to see a consumer pickup in China is the question on the back of that.
Absolutely. Does the stimulus that we're seeing, does it stay in stocks? It spreads into property, it seems. Is that enough to drive the consumer over in China? Thinking about where we go on the global economic story, a lot at stake for Germany, of course, from what goes on in China. And that takes us on to a conversation coming up in the next hour. We'll be, of course, tuning in just 4 minutes, in fact, for the IFO numbers, the climate, the assessment of the current state and the expectations all seen dropping versus the prior period on the IFO reading on Germany.
October, is it live for the ECB? That is the key question. We'll maybe ask that question to the president of the IFO Institute. Clement Fust is going to be joining Bloomberg next. That's it for the opening trade. The Pulse is up next. This is Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, is emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
China stimulus boost, European stocks rise after a blistering rally in China and Hong Kong as Beijing unleashes unprecedented support, including a rate cut and the biggest package yet to boost the housing market. A major escalation between Israel and Hezbollah. Israeli airstrikes kill nearly 500 people across southern Lebanon in one of the deadliest days of fighting in 20 years. Plus, top officials square off as UniCredit becomes the biggest shareholder in Commerzbank. German Chancellor Olaf Scholz calls the move unfriendly. We check in on European stocks then with China and the action coming through on the stimulus front and centre. China turbocharging global markets, at least for now. The question is, will this be sustained? A focus on the automakers, luxury and basic resources, all getting lifts on the back of the stimulus that's coming through from Chinese policymakers. And that's before you get the fiscal response as well. This is focused on monetary policy. The CAC 40 over in France getting a lift from the luxury space, up 1.4% so far in the session. The UK, the FTSE 100 getting a lift from basic resources. The miners are rallying, up 0.5%. And over in Germany, the DAX, you look at the auto sector, the last time I checked, Mercedes-Benz was near the top of the list. The DAX getting a gain and a boost from the auto sector, again linking to the China story, up 0.8%. Let's flip the board and look cross-asset. Euro-dollar in focus as well. The soft data out of the Eurozone, to what extent will that be offset by the strength, if there is some, renewed strength of the Chinese economy? Will that come to the aid of the Eurozone as you look at the challenges in that economy? Markets are starting to increase their bets around when the ECB cuts. October, it seems, is now in play. Not a certainty, but in play. Markets pricing in close to 2 full additional cuts by the end of the year. The benchmark US 10-year on the back of those FOMC officials, Austin Goolsbee saying there will be multiple additional cuts coming through into the next year. In focus as well, 376. Euro-dollar out 111. Brent 74, close to $75 a barrel. Of course, the Middle East tensions, but also the demand impulse out of China in focus when it comes to oil. And iron ore is rallying in the session. That's lifting basic resources up almost 6%, $94 per ton for iron ore. Lines crossing right now. We talk about the health of the Eurozone economy with the focus, of course, squarely on Germany, given the PMIs that came out yesterday. Germany, the September IFO Business Confidence Index coming in at 85 85.4. That is pretty significantly below the estimates of 86. Expected to cool. That was the expectation, but it's cooled more or come in lower than the estimates at 85.4. We know the challenges, of course, around the auto sector in Germany. We will be speaking to the president of the IFO Institute in the next 10 minutes for reaction. The show coming up in just the next couple of seconds.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London, standing in for Francine Lacqua. Now, European and Asian stocks have rallied, as I mentioned, after China's central bank unleashed a raft of policy support for the economy. It is the government's broadest effort yet to hit this year's GDP growth target of about 5%. Let's get more in terms of the reaction and bring in Bloomberg's Jill Desis standing by with the details and the implications. So, Jill, a flurry of rate cuts, liquidity support measures announced today. What is most likely of all the measures that we've seen announced today from officials in Beijing, primarily the PBOC, to move the needle on the growth picture of China?
Oof, yeah, Tom, I mean, what a flurry of different actions here. I mean, you had these rate cuts that were announced. You had, this exploration of a new stock stability fund. You had some additional liquidity support to the tune of around $113 billion worth coming out in terms of some monetary policy support there. But I really think you kind of have to look at the property sector measures here as, some stuff that actually does seem, in combination with everything else, a bit materially different. I think, we did see officials here today announce that they were going to lower borrowing costs on mortgages worth somewhere around 5.3 trillion yuan. So I mean, you've really got sort of that massive amount, or dollars rather. You've really got that massive amount that's kind of coming into play here. You've got some additional measures that you're taking to kind of sort of ease the property crisis for China. I think that's probably what really makes the most sense here in terms of stuff that's actually going to help alleviate some of the property crisis there. But I also think, Tom, that the bottom line here is that the the transparency that you've really had from officials today, this hour and a half long press conference that they used to detail a lot of stimulus, the potential for remember more measures to come. PBOC Governor Pan Gongsheng actually talked a bit about how they could see rates lowered in the future. He kind of telegraphed that a little bit. I think all of that in combination kind of shows you that Chinese officials are really changing the calculus here. And while this might not be some kind of extremely super massive bazooka stimulus, it's still incredibly significant and potentially foretells something more to come.
And the markets are reactive. We've seen that strength coming through for the benchmark CSI 300, adding more than 4% over in Hong Kong, where you are, the HSI, up a little over 4%. I guess the key question is, when we speak to the analysts, when we speak to those engaged with the China story at this level, Jill, what is your sense that they think this could be sustained, or is this all going to fizzle out in the next 24 hours or so?
Yeah, Tom, the analysts that we're talking to are saying that, look, we've seen this kind of thing before where you get some big announcements and then it does kind of fizzle out. It's really going to depend on whether there's additional measures announced within the coming days and weeks to actually see some sort of a, sustaining growth there. I will say what was actually kind of interesting to me off of the press conference this morning is that stocks got a little bit of a boost at the beginning, but then kind of paired gains. But then it was really, some very, very late in the game stuff at the end of the presser on that stock stability fund that they're exploring that kind of, made everything jolt back up again. Now it kind of seems like investors are digesting what they've actually heard and trying to decide whether or not that's actually moving the needle. I think, though, what we'd have to see, Tom, is something that actually tells us that in addition to everything that's going to be announced, that was already announced today, is there anything more wholesale? Is the finance ministry going to announce anything, on the fiscal side to sort of support things? We've heard a lot from the PBOC. Is there anything more comprehensive that is going to add to this drumbeat of new measures that could help the economy?
Okay, already looking for more from officials in Beijing. Jill Desis, thank you very much indeed on a big day for China and the response from policymakers, and the key question as to whether or not it will be enough, of course, to turn around the consumer sentiment, the real estate sector, and continue to put a floor under the stock market of China. Let's switch focus right now. We've been hearing, of course, from a number of FOMC officials in the last 24 hours or so as well. A handful of Fed officials have left the door open to more large US interest rate cuts. I think 50 basis points, of course. It comes as leading hedge fund managers and investors gather at London's Wembley Stadium for the 5th annual Liquid Alternatives Summit, snappily named. Bloomberg's Danny Berger is there with a guest. Danny.
Tom, thank you so much. And I'm so glad you guys just finished talking about China, because that is really important here, too. I'm pleased to say that I'm joined by Karim Musalim. He is at Selwood Asset Management, CIO of Equities. Karim, thank you so much for joining this morning.
Thank you for having me.
So I know you play in the pool of European equities, but China exposure, of course, is really consequential. I know you like commodities, too, so maybe you can take a victory lap here, but how big of a difference does it make this morning to hear the news of more stimulus coming from China?
Yeah, I think it's great to see, and it's something that's been that we've been waiting for some time. It hasn't come through until this morning, and I would say there's a number of things at play here with commodities. Obviously, there's a short-term boost to prices that we're seeing this morning, but I kind of like to make a difference between some commodities that are very exposed to the property sector, and I think that's going to be in a very tough spot for many, many years to come, and other commodities like copper, for instance, which are critical for the energy transition, the decarbonization of the economy, and even that commodity has been sort of has been under pressure, all of this year because of this negative sentiment towards China.
So does this change anything in terms of your exposure? You already have it, but you want to double down now.
No, I mean, we've already had a decent amount of exposure to some of these commodities, not the whole complex. I think oil is in a different spot because of all the spare capacity, especially within OPEC+. I said copper is in a very different place, but all of these commodities have traded almost, one for one. And I think that news today will probably affect sentiment to some extent, which is very good for us.
Within the markets, there have been a couple themes that have been sustained, China being one of them, but elsewhere, a lot of things swinging back and forth. You have, for example, big stocks, some of the biggest in the world, like NVIDIA, trading like penny stocks. This type of volatility, do you think that this is the new norm for this market, to have such big names trading hundreds of billions of dollars a day?
Look, it's amazing the difference between the U.S. market and the European market. You have a depth of liquidity, lots of options activity, retail activity in stocks like NVIDIA, as you mentioned. Europe is a very different market altogether, with much less liquidity, much less depth. But I think what is really fascinating is to see how much the market has changed over the last 20, 25 years, particularly in Europe, with much more of the shorter-term players that dominate the price action on a day-to-day. And those type of investors are very focused on short-term price momentum and earnings momentum. And I think that's been the most fascinating thing to watch, because there's very few investors like us willing to take a slightly longer-term view.
Does that make your job harder? Because you're doing equity long-short. You're not doing those types of strategies. Is it harder to be an equity long-short manager today?
It's harder when you're trying to show steady performance and steady returns month in, month out. Our focus is on picking stocks and taking a 1 to 2 year view. So obviously that comes with a little bit more volatility. But I do think that ultimately the price is bigger if you're able to hold on to your positions. Hence my call on copper, Glencore in particular, which I think is an outstanding stock to own in this kind of environment, but it's been pretty difficult to own this year.
Are clients receptive to that message?
Yeah, look, I think there's a market for everything, every strategy for everyone. Obviously, if you're looking for very short-term tactical opportunities and dislocations, you have a whole host of funds you can look at. If you're looking to play, again, the longer game, there's very few of us left in this market, and I think that's exciting.
It's an advantage because there's not many of you. But do you think that this is a permanent shift, that you have these multi-strat pod shops who do things like volatility, these types of strategies, trend following? Is this a permanent shift that this is the new star breed of hedge funds, and unless you're that, you can't really launch a new hedge fund?
Look, I think it's become incredibly difficult to launch a new fund, and we've seen it. Having launched 2.5 years ago, it's been a long road to get to almost 200 million of AUM today. But I think ultimately it's a marathon, so you can't look at it, day to day. And I think if you deliver good returns, ultimately money follows. But I do think ultimately that this lack of managers taking longer-term views presents obviously some risks that we need to manage, but also some incredible opportunities for the future.
Do you think it's also harder to run a fund in London and maybe even launch a fund in London when there's so much uncertainty around taxes and what the new Labour government will bring?
Yeah, but I think it's true for the whole of Europe in general. We have a lot of regulation, maybe too much regulation in some cases. ESG for a period of time really dominated anything you could do, and it attracted a lot of capital to funds that were doing a bit of greenwashing as opposed to really changing the world for the better. I think some of that has shifted a little bit, but overall in Europe we lack the depth of capital that you have in the US, that you have in Asia. So it is definitely more challenging in Europe than in the US, but not just because of tax reasons.
Well, at least we're not hearing about offices being raided for greenwashing and that sorts of thing. So I think that's an improvement. Kareem, thank you so much for joining this morning. It was really a pleasure to talk with you. Tom, that is Kareem Moussalim of Selwood Asset Management.
Danny, great conversation. Thank you very much indeed. Danny Berger, of course, at the Kepler Hedge Fund Summit. There's plenty more coming up. Stay with us. This is Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power. This is Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching the close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome back. Chinese stimulus powering the moves higher in terms of European stocks, with a particular focus on the sectors heavily exposed to the world's second largest economy. Think autos, think luxury, and think, of course, the mining sector as well. You can see Anglo-American, currently the top performing stock in Europe, gaining more than 7%. You look at the iron ore price rallying on the back of the stimulus being pushed through, and the package of measures to support China's beleaguered real estate and property market. Iron ore is up almost 6%. Copper getting a pop as well, up 1.5%. That is driving basic resources higher. Anglo-American, a key beneficiary at this point. Rio Tinto also in the mix, of course, adding 222 points, up 4.6%. LVMH in the luxury space also getting a lift, along with its counterparts and competitors like Hermes. LVMH up 4.2%. And there's Mercedes-Benz in the auto sector, the DAX and the CAC, the national indexes getting a lift from the different sectors to which they have that China exposure. Mercedes for some time in a while has been able to say this, getting a break and up 2.2%. Again, on expectations that maybe the sentiment around the Chinese consumer will start to change, and maybe on the back of these measures, they will feel they have a little bit more cash in their pockets to be able to spend on some of these items. That remains a key question, of course. Coming up, we're going to take a closer look at the German economy following that IFO survey data with Clemens Fuest, the IFO Institute president. That conversation coming up next. This is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rain World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome back. Now, Germany's business outlook has again worsened, reinforcing fears that Europe's biggest economy is in a recession with no quick rebound imminent. The president of the IFO Institute, Clemens Fuest, joins me now for details on that survey. Clemens, thanks for your time. Always appreciate your insights. So softening again across this survey in terms of the Institute's expectations gauge dipping to 86.3 in September. What are the biggest headwinds for this European economy with Germany at the core right now?
Well, I would say the key weakness is really manufacturing, which is so important for the German economy. We see with this weakness across the board, really, machinery, the chemical industry, electrical equipments, and the car industry. And companies are telling us we are lacking orders. Now, on top of that, we have weaknesses in the service sector, especially in those parts of the service sector, unsurprisingly, that are related to industry, like logistics, engineering, services, and so on. So the overall picture is bleak, really.
The overall picture is bleak, and in prior conversations we've talked about the divergence between manufacturing and services, and as you say, they are now, worryingly, starting to align a little more. When do you expect, are we getting to a point where a floor is being put under the slowdown in manufacturing, or is there further pressure to go there? And where are we in terms of the declines around services?
Well, the trouble is that we are seeing a decline in investment in manufacturing, and as long as we see that, the worry is that the production potential of this industry is declining further, and as is production and value added. So it's not quite clear when we will be reaching the floor. Of course, partly these are external conditions, exports to China, and depending on the Chinese economy, that may improve in the future and may not. But within Germany, it's difficult to see a floor. It's really a weakness of investment in Germany. A lot of companies are producing for domestic investment. A lot of companies are produce equipment for investment, and that's not stabilizing. What we also see is a very low level of investment in construction, and that also has an impact on manufacturing, of course, because a lot of companies are producing equipment for them. If construction stabilized, that might help manufacturing too, but none of that is in sight at the moment.
Is a recession in Germany now your base case?
I think we cannot exclude that we'll end up with a negative growth number this year. A lot will depend on consumption. That could be a countervailing effect. But so far, we do see rising disposable incomes, but that doesn't translate into consumption. So the savings rate has increased, suggesting maybe that people are worried about the future. I mean, if that changes during the year, we might escape a recession, but in any case, the German economy will stagnate, and with these numbers coming in today, it might even be a minus.
Does the ECB need to act more aggressively? Does an October cut, a third cut from the ECB in October, does that need to come through, and will that do anything to put a floor under this economy?
Well, that would be a surprise, but with the data coming in today, the likelihood certainly increases that the ECB will change its mind and cut in October. Of course, the ECB looks at the Eurozone as a whole, and Germany, in a way, is a negative outlier. So what counts is the overall situation in the Eurozone, and for the ECB, it's a balancing act between relatively sticky inflation, especially in the service sector, and a weakening economy. But with today's data, we see in the data that companies are also expecting to cut prices in Germany, and that takes pressure off inflation. So all of that suggests that the case for an interest rate cut has at least become stronger.
We talk about the stimulus out of China. Could that prove a catalyst, a positive catalyst for Germany and the Eurozone in the months ahead?
I mean, the slowdown in China and in Chinese exports is one of the reasons the German economy is in difficulties. I mean, if that stabilizes, that would help. It will not alone bring positive growth rates to Germany, but it would be a stabilizing factor. Still, Germany is particularly exposed to the automotive sector, to the car market in China, and there are the weaknesses of German companies there regarding electric cars are really structural. So it's not quite clear they will benefit if the Chinese economy picks up, but of course it would be a positive overall effect.
Okay. IFO Institute President Clemens Fuest, always appreciate it. Thank you very much indeed. Coming up, Israeli airstrikes on targets across southern Lebanon kill nearly 500 people. We bring you the latest on the Middle East. That's next. This is Bloomberg.
why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London. These are your top stories. China stimulus boost, European stocks rise after a blistering rally in China and Hong Kong as Beijing unleashes unprecedented support, including a rate cut and the biggest package yet to boost the housing market. A major escalation between Israel and Hezbollah. Israeli airstrikes kill nearly 500 people across southern Lebanon in one of the deadliest days of fighting in 20 years. Plus, another recession warning in Europe's biggest economy as Germany's business confidence falls once again. The IFO president just told us the outlook for Germany is bleak. Let's get the latest on the Middle East right now, though, because nearly 500 people, as we mentioned, have been killed in Israeli strikes in southern Lebanon in the deadliest day of fighting since the 2006 war between Israel and Hezbollah. Bloomberg Horizons anchor Jemana Besechi joins me now for the latest. Jemana, what do we know about these Israeli strikes, the casualties, and where things stand from here?
Yeah, well, it was the deadliest day in Lebanon seen since the 2006 war between Israel and Lebanon that went on for over 30 days. What happened was the Israeli military launched airstrikes across what they say were 1,300 Hezbollah targets dotted throughout the country. So this wasn't just specific to southern Lebanon. There were also strikes around Beirut, some of the suburbs of Beirut, and even eastern Bekaa, which is close to the Syrian border. By the end of the day, the health ministry said that almost 500 people were killed in the attacks, including about 100 women and children. More than 1,600 people were wounded. Now, the Israeli military say that they were aiming for Hezbollah targets and that many of those who were killed were members of the Lebanese militia Hezbollah, arguing that the group themselves had placed some of these private rocket launchers in people's residences. And earlier on in the day, the IDF had given a warning to many residents, warning them to leave their homes as soon as possible and as soon as they actually could, as soon as they could facilitate it in anticipation of these rockets being fired. Now, later in the afternoon, Hezbollah also responded, sending rockets into northern Israel, into Haifa. Sirens went off. Most of the rockets were intercepted. But just recapping the events of the last 24 hours, Tom, as you can see, it was a very deadly day for Lebanon, but also it posed a serious escalation because on both sides, there doesn't appear to be any appetite of them wanting to back down.
Okay, and just briefly before we let you go, Jemana, what are the next steps? What are we looking for next? What's happening on the diplomatic front? And to what extent should we, could we and the warning around this, expect further retaliation, of course.
Yeah, well, it appears as though there looks like there are going to be more airstrikes set for today as well. The Israeli Prime Minister Netanyahu saying, "I want to clarify Israel's policy. We do not wait for the threat. We are ahead of it." He predicted complicated days ahead. Now, all this is happening during the same time as that UN General Assembly meeting that is taking place in New York. The Israeli Prime Minister is traveling there towards the end of the week. He will be delivering a speech on Friday. The Lebanese Prime Minister wasn't supposed to be attending, but this morning his team have announced that he will actually be going. The U.S. have been trying to de-escalate and bring down the temperature in the region, urging on all parties to show some restraint. But at the same time, we have heard that the U.S. via the Pentagon are looking to send more forces to the region in anticipation of a possible flaring up. So all this is going on. The next few days will be key for direction.
Okay, Jemana Pasechi, thank you very much indeed. And an important update, of course, in terms of what is unfolding in the Middle East, that increase and escalation in tensions between both sides. Jemana Pasechi, our anchor of Horizons Middle East and Africa. Now, switching focus, Donald Trump says that if he returns to the White House, his first call will be to Chinese President Xi Jinping. He has accused Beijing of failing to honour an agreement that saw the US reduce some duties in exchange for China increasing its purchases of US exports, including $50 billion in agricultural goods. The US presidential race has seen both Trump and Kamala Harris vow to take a tough stance against Beijing.
The first thing I'd do is my first call, I'm going to call up President Xi. I'm going to say, you have to honor the deal you made. We made a deal. You'd buy $50 billion worth of American farm product, and I guarantee you he will buy it 100%. He will buy it. Second thing I'm going to do is I'm going to say you have to give the death penalty to your fentanyl dealers.
Okay, now switching focus, because despite today's bump higher, political uncertainty in France has upended markets, with the CAC underperforming European peers over the past year. Traders are now looking to the Élysée Palace to assess the new government's ability to tackle the country's spiralling budget deficit. The countdown to the budget, of course, is in focus in France, as it is in the UK. I'm pleased to welcome now Stéphane Boujnah, the CEO of Euronext, someone who has a past as well in terms of devising previous governments. That was one of your old roles, but right now, of course, CEO of Euronext. Stéphane, thanks for joining us in the studio. Talk to us about the politics of France and the impacts on the capital markets of France. Before we broaden out the conversation, is it casting a shadow over the capital markets of France, the uncertainty, the political uncertainty?
Well, as you may know, Euronext is a European company headquartered in Amsterdam. I'm a French citizen, so I have skin in the game in what's going on in French politics, but I'm running a European company. Now, just to answer your specific question about France, the president has called for snap elections in July. The new parliament is divided. He is appointed following a long consultation, a seasoned politician who is experienced at home and has a great track record in Brussels in European affairs. This cabinet seems to be committed to continue the pro-competitiveness agenda and the pro-business agenda. So let's see. I'm quite confident that they will do their best to tackle what is on the table, i.e. the rebuilding of public finance, but like many European countries. So, I would not factor in political volatility as a discount on the European risk. This is the cost of democracy, like in Belgium, in the Netherlands, in Germany, in Italy. So let's look at the core of what Europe has to offer: 450 million inhabitants, great wealth, great savings.
Right. Well, the yield spread, of course, of French debt over its German counterpart suggests that risk premium is there. I mean, to many looking at the French cabinet, the French government, I will move on, but just on this, given your background as well, for many they would say it's not a question of if this government collapses, but when, given the political forces at play.
I don't want to comment that. I run Euronext. I'm not commenting on local parliamentary politics.
Okay. At what point, though, do you need that political certainty in order to rejuvenate the capital markets of France? And again, I know that you're across Europe, but Paris is part of the mix for Euronext.
There is no such a thing as European. There is no such a thing as capital markets of France. There is only capital markets of Europe. I mean, this is except for public debt. The reality is that we operate in an integrated capital market in Europe. Euronext operates a single order book, a single liquidity pool, a single technology platform with 12 billion of shares, 12 billion of euro in value traded every day. So it's twice the size of the London stock market. With an aggregate market capitalization of 7 trillion euro of all the companies listed on Euronext, which is a single integrated market. We look at Europe as a single integrated market.
Have you been benefiting from some of the volatility? We saw that in the first part of August. You've seen that benefit?
Of course,
do you expect that to be sustained?
I don't know.
What's activity looking like right now?
Well, we have a very diversified activity portfolio in terms of trading. Equity markets have not been as strong as they could have been. We are fortunate enough to be exposed to fixed income with MTS, which is today 4 times the type of volumes they had when we bought the companies. We are fortunate enough to be exposed to electricity trading with no pull. So electricity and commodities markets are doing extremely well. So the integrated markets in electricity in Europe, in commodities, in fixed income are doing extremely well, even if equity markets are not as strong as they used to be. But I'm confident that when they recover, and they will come back anytime, because the direction of travel of interest rates is pretty straightforward, pretty clear, we will be in the right spot.
Is that the key catalyst then for equity markets to come and that activity to come back?
By all means, it's a very powerful catalyst. It's not the only one. As you say, the risk profile, the underlying performance of companies is the ultimate driver of stock valuation. But clearly, the switch that is now unavoidable in terms of direction of travel of interest rates is going to be a booster to equity markets.
Sounds like you might be one of those calling for a cut in October from the ECB. Might be helpful to the business. As you project out 12 months, what's the IPO pipeline looking like? Give us some numbers in terms of what you see.
I'm reasonably optimistic because of the reason I've just mentioned on the underlying drivers of equity markets, and also because the pipeline is thick. Some deals have been postponed, but the pipeline is pretty thick for the coming year. We believe that 25 will definitely be a stronger year than 24.
Okay, 25 a stronger year than 2024. Of course, the 2024 has been pretty challenging, hasn't it, for the capital markets? Look, you talk about the benefits of this integrated market that you have across Europe. Total Energy and the CEO there, of course, also a French national, looking to list in New York. What do you make of that?
They don't look for listing in Europe. They have ADR in the US. They have a fundamental valuation problem. On the one hand, European investors are not big fans of oil and gas as they used to be. On the other hand, US investors love oil and gas. That's why they like Chevron, they like Exxon, and that's why the multiples of those peers are stronger than the one of Total. So Total is looking for a tool to attract more US investors. Large US asset managers don't need to invest in US listed instruments, but some smaller ones want to invest in US listed instruments. So we are working with them as to a tool to solve that problem. But there is no plan, as far as I understand, at Total to delist from Europe, to move their headquarters, to move their main listing venue, or even to list shares in Europe.
Where are you on that valuation gap? Is that just a structural issue that Europe's going to have to contend with, or does that start to close in the short to medium term?
Well, I was referring to the oil and gas sector. I mean, I'm not a specialist of oil and gas, but clearly the rationale or the debate around the valuation of Total is about the fact that in Europe, the ESG preferences, in particular on the E and the environment, have developed very, very strongly, whereas in the US, it's more a debatable issue, and therefore the appetite for oil and gas, both in debt and equity in Europe, has declined significantly, whereas in the US, it has been sustainable.
Okay, Stéphane, always enjoyable conversation. Thank you very much for coming into the studio. Stéphane Boujnah, of course, Euronext CEO. Coming up, our conversation with the CEO of mobile payments firm Boku. We discuss corporate results and the health of that fintech. That is next. This is Bloomberg.
David Weston,
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Next month, alongside our Business Secretary, Jonathan Reynolds, we will publish our plans for a new industrial strategy for Britain. A strategy for driving and shaping long-term growth in our manufacturing and service sectors. A strategy to unlock investment, create jobs and deliver prosperity. A strategy to help break down barriers to regional growth, speed ahead to net zero and clean power by 2030, and build prosperity on strong and secure foundations.
The UK Chancellor, Rachel Reeves, striking an optimistic tone in her speech to the Labour Party conference, some would say belatedly. Companies are waiting to see what the new government, of course, means for the country's tax and funding environment ahead of the upcoming autumn budget. One of these is Boku, a mobile payments company founded in San Francisco but listed here in the UK. The fintech, which works with the likes of Amazon and Google, to name just a couple, just reported revenue up 24% in the first half of the year. Let's discuss the earnings story then, and also the regulatory front, the tax issues as well, amongst a number of these jurisdictions. Let's bring the CEO, Stuart Neal. Stuart, let's start on the earnings story then. So 24% increase year on year in the first half. Give us your take on how that positions the company going forward. Is that growth momentum likely to be sustained into next year?
Yeah, good morning, Tom. Yeah, absolutely. You know, we're really excited about what the future is going to bring for the company. Our growth really comes from the fact that we work with some of the world's biggest technology companies, and we provide those technology companies with access to effectively paying users all around the world. So the more we can enable growth for our customers, the more our company's going to grow. We have some really exciting things coming on stream in the second half of the year. So yeah, I have absolutely confidence that the growth is sustainable.
Okay, Stuart, where specifically, you're a global company, you have an exposure across a number of different countries and businesses as well. Where specifically is the strongest kind of growth coming for at this point?
What we're seeing is a global macro trend. You know, research from Juniper suggests that by 2028, 59% of global e-commerce is going to happen using local payment methods. So the answer is really it's happening everywhere. In the first half, we put customers live in Asia Pacific, we put customers live in the Middle East, and we put customers live in Europe. So the shift to local payment methods is really a global shift. Maybe it started in the East, in China and Asia Pacific, but it's certainly moving west.
Okay, you have that touch point, clearly, with all these merchants that you have as part of your client list on the global economy to some extent, certainly the health of the consumer. So as we try and weigh up where this global economy is going, let me ask you this. With the data points that you see, Stuart, are you seeing consumers pulling back? Are consumers becoming a little bit more conservative, more cautious?
We don't really see that. I mean, what we do see, I mean, we're very diversified. So what we're seeing in one part of the world might be different in a different part of the world. You know, many of our customers are providing kind of content that is incredibly popular. So whether that be gaming, video streaming, digital downloads, online media advertising. So we're seeing diversified growth everywhere. So I'm not actually seeing any slowdown, candidly.
Okay, Stuart, specifically here on the UK, we're counting down to the budget. What you're listed in the UK, is there anything specifically you want to hear, you want to see from this Chancellor in this budget that would help you, help your sector?
But Boku is part of what we call the sort of fintech sector, and I believe that the UK has an incredible pedigree in fintech. If you think about companies like Revolut or Wise or neobanks like Starling or Monzo, I consider Boku to be in amongst that portfolio of companies. We should be proud of these companies, and I'd like to see any government really do something to stimulate and encourage increased investment in the sector. We have a real global advantage in fintech, and I think we should be promoting it as much as possible.
Bloomberg had a story around the DOJ, of course, the Department of Justice in the US, probing Visa over alleged anti-competitive measures within the debit card space. Just broadly, in terms of the incumbents, Stuart, and you talk about the fintechs here in the UK, are the incumbents, are they setting up an unfair advantage? Are they unfairly holding back competition in this space?
Well, I think what we do see from our vantage point is in markets like India and Brazil, central banks taking ownership of the payment system. And so in those two countries, the predominant payment method that is being pushed by central banks is what we call A to A, account to account, which means a direct payment from the consumer's bank to the merchant's bank. And you'll notice from that ecosystem that it actually cuts out the need for an intermediary payment system in the middle. So I think, to answer your question, I think this is happening organically around the world without sort of needs for the US intervention, which frankly the US is a very card-centric market anyway.
Okay, Stuart Neal, Boku Chief Executive, thank you very much indeed on the earnings story and some of the regulatory challenges facing this space. Earnings up 24% increase year on year. Stuart, thank you. Coming up, hostile or not, from fintechs to mega banks, the bank takeover that has caused a diplomatic spat between Germany and Italy. We have the latest on, of course, UniCredit and Commerzbank. That's coming up. This is Bloomberg. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back. Now, diplomatic relations between Italy and Germany have taken a turn for the worse after UniCredit moved to increase its stake in Commerzbank. The German Chancellor says it's a hostile takeover, but that has been rejected by Italy. Bloomberg's Oliver Crook joins us now from Berlin for the latest. The speed, then, of the CEO of UniCredit's approach, and some would argue aggressiveness on this deal, at least this attempted takeover, has been pretty remarkable, Ollie. Where does this story stand?
Yeah, Tom, it's crazy to think that about 10, 11 trading sessions ago, no one was any the wiser that Andrea Urschel was in the market buying up shares of UniCredit, ended up with 9% here, then says he's going to keep some flexibility with what to do with it. And everybody sort of in Germany was scratching their heads, from the government, from Commerzbank, from Deutsche Bank, to try to figure out how to deal with this problem, because it's something that really nobody anticipated. So going into the weekend here, you had the sort of finance ministry still very diplomatically pouring cold water on the deal, saying that we really think Commerzbank is better off alone. Monday comes in, the bid drops out. Halfway through the session, it comes out Andrea Urschel has bought an 11.5% additional stake, taking the possible stake to 21%, would be the biggest shareholder. We should say he hasn't realized that yet because he's holding it still in derivatives because he doesn't have regulatory approval from the ECB to take his stake above 9.9%. But all of this in culmination, basically, Tom, has Olaf Scholz, who's at the UNGA, trying to deal with international relations, having to field questions about Commerzbank and basically saying that this is a hostile takeover, it's unfriendly, there's not a good way to deal with banking, and he considers this to be a basically totally inappropriate course of action.
Well, look, as you're suggesting, and as we see from that quote from Chancellor Olaf Scholz, this is becoming political. Both sides, Germany and Italy, voicing or at least taking a stand on this. What is the politics of this, Ollie?
Yeah, so there's the domestic issue, right? For the government, this looks terrible. It speaks to the sort of kind of disorganized nature of this sale. Commerzbank, we haven't talked really about the shareholders. Tom, a lot of people who are shareholders in banks like to make money. This UniCredit's sale potentially could make them a lot of money. How are they going to feel about it? They're going to meet with the board for the next couple of days. The unions have been outspoken. And now if you change up the board, you have Friedrich Merz coming out, the opposition basically saying that the government is incompetent, has totally mismanaged this, and it's terrible for the sector. But Tom, what I think is most interesting is you look at the international perspective on this, what the Italian foreign minister has come out and said, which I think is absolutely scathing and really speaks to some of the difficulties here within Europe. I don't understand why when someone comes to buy in Italy, they say that we are a European system, and if an Italian goes to buy out, it's no longer a single market. And Tom, I think this speaks to the heart of this question of European competitiveness, because what all of these policymakers and Mario Draghi are talking about is a more fluid, more robust way of doing business across the European continent. If the Germans come out with a heavy hand and say, no way, that sends a very strong signal about what's possible here in Europe.
Yeah, it's a fascinating story, and you've been across it all for the beginning for us with the detail, the analysis. Oliver Crook in Berlin, thank you very much indeed. Commerzbank, by the way, is up at 1.7% so far in the Tuesday session. European stocks more broadly gaining 0.7%. Thank you, China, for that. Will it be maintained is the question. Up next, Bloomberg Brief with none other than Manus Cranny in New York. Stay with us. This is Bloomberg.
reach down to the 18 to 35-year-old market. How do we bring these kids, these influencers, this new generation of people interested in the game of golf? There's 738 million people in the world who are interested in the game of golf. Don't play the game of golf, but interested. There's about 60 million golfers. So we have another 670-odd million people we can go figure out how to get them interested, not just in live, but in the game of golf. And so we sit down and you talk about this internally with your production team, you talk about with your marketing people. When you look at our audience base today, that we have like about just around 50% of our ticket sales are 45 years and old and younger. Following the PGA Tour, it's the oldest aging demographic in sport. It's 67 and a half. So in a matter of a year and a half, basically, we've pulled that 67 and a half down to 45 because of our product, because of the entertainment side. There are places around the world where 32% of our ticket sales are women. So they're coming to an event that they feel inclusive with. Right? So all of a sudden, we're seeing these data points coming out going, my gosh, why haven't, we're owning this space.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Good morning from our global headquarters in New York. I'm Menace Cranny. You're welcome to Bloomberg Brief. Let's set your agenda. Embracing the risk on with a message from the Fed. Many more cuts ahead. A stimulus blitz, China unleashes a raft of support measures to shore up growth. And we're live from the 5th annual Liquid Alternatives Summit in London. We'll bring you our exclusive interview with Cliff Asness, AQR Capital Management's co-founder. Very good morning. Take a look at risk. Equities are nicely bid. Is it an extension of a melt-up, a FOMO, of Tina? You take your choice of which superlative you want to do. But the Fed's narrative from Goolsbee was how tight the real rates are. We'll talk more about that in a moment. You have stimulus coming from China. We've got consumer confidence today. And Nomura do warn that we are in a forced re-risking and exposure-grabbing market. Stocks are bid. S&P up by 0.25%. To the bond market, the narrative here is even though input prices rose a little bit yesterday, we got a small drift higher in yields this morning. Twos auction today, $69 billion worth of two-year paper coming today. And the collective narrative from the street, BlackRock, PIMCO, BMO, and Morgan Stanley, is a continuation of this disinversion and steepening. By the way, BlackRock say there's a very aggressive normalizing away from restrictive rates. Let's stay to play on the bond and the equity markets. As I say, everything's getting a nice boost this morning. Part of the narrative is the China story, unveiling a package of monetary stimulus in an effort to revive the nation's economy. Jill DeCease is with us from Hong Kong. Jill, this is a mighty combo of reserve requirement drops and galvanizing the national team, one could say, for the stock market. What scale of stimulus are we talking about?
Yeah, that's right, Menace. So, look, this is about as much as you could really throw at the China slowdown from a monetary policy side as can be expected here. I mean, as you just mentioned, you've got some really big superlatives that we're dealing with here. This announcement of a cut to short-term policy interest rates and a cut to the reserve requirement ratio for major banks. It's the first time that we've had an announcement of that nature on the same day in about a decade. You also have, some lowering some borrowing rates affecting booking somewhere to the tune of $5.3 trillion worth of mortgages. That's a pretty significant move on the property sector side. And then, as you just mentioned, Manus, you also have some liquidity support being provided to help the stock market from the central bank to the tune of about $113 billion worth, alongside some other measures, including this exploration of a new stock stability fund. So where this all really amounts to is probably something that's going to help boost the economy to ultimately hit its economic growth target of about 5% by this year. That was something that was really, really out of reach just before all of these announcements came. Maybe there's still more to come. We'll have to see.
Look, the criticism last year was it was a piecemeal response by China. They were never going to make their 5% growth target. This briefing, what does it say to you about a shift in policy approach from China?
Yeah, Manus, I think that it's really about the communication style here more than anything else, right? So analysts were looking at the concepts that were announced this morning in China, saying, look, a lot of this is stuff that we actually thought that China needed to do anyway. So it's not really something that's to the scale of, say, bazooka-style stimulus that you were seeing after the Great Recession in 2009. But what we have seen is really sort of the shift in how China is explaining a lot of this and how they're all unveiling this. I mean, the PBOC governor, the central bank governor, Pan Gongsheng, coming out and giving this press briefing just before announcing tweaks to policy rates and such. I mean, this is something that would have been unheard of just a couple of years ago. And the fact that he also gave forward-looking guidance that more cuts were to come, I thought was particularly telling as well. So it seems that the market certainly took all of that and said, look, you know, this is something to be excited about. We did see that reflected in equities markets in China and Hong Kong. Now, whether that actually is a sustained momentum, I think still we have to kind of wait and see. But at least for today, markets stood up, took notice, and said, you know, maybe there's actually something to glean from this. Maybe China is actually taking this seriously.
Indeed. As you said, not the crisis response of the GFC, but of size and substance. Jill, thank you very much. Jill DeCease in Hong Kong. Joining me now is Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, good to have you with us. So the size and the scale of this stimulus, in terms of the risk narrative, it's pro-risk globally, but I wondered, does it just reaffirm U.S. exceptionalism relative to perhaps the others? Your first take on the stimulus.
Thanks, Manny, for having me on. Look, I think the stimulus measures it's clearly positive, and there had been a lot of growing speculation that at some point in the near future there would be some kind of announcement, because it's been such a disappointing set of economic data over the last couple of months. So it's positive. But as Jill had said, this is very much on the monetary side. We're still waiting to see what happens on the fiscal side, because that's what I think is really required in order to boost that consumer confidence. You know, if confidence is low, then reducing interest rates doesn't really do enough, because there's just not enough demand for credit. So we need to see what happens on the fiscal side if it comes through in the next couple of days. And then the other side of it is how is it all going to be implemented? I think we've seen a number of occasions in the past where there have been some quite impressive announcements on the property side, but when it comes to implementation, it's been a little bit disappointing. So this is good news. We're still unconvinced about how long this is going to be sustained for.
Yeah, and it is about that convincing of markets, which takes us to the monetary policy here. And you say this about the 50 basis point cut, an unusually large 50 basis point reduction. It appears designed to preempt any significant economic weakness, and signals that this Fed will go to historic lengths to secure a soft landing. Can you just expand on what you mean by historic lengths?
Yeah, I mean, moving rates by 50 basis points when you have growth sitting near the high twos in this quarter, when you have no evidence of layoffs, there's no financial crisis brewing, no asset price bubble popping. So this is quite unusual. You've only seen those kind of moves when it's typically associated with something serious, crisis happening. So I think it is historic. That's not to say it was a wrong move. It was an unusual move. And I think everyone has to, you know, in the way Powell said that it was a recalibration, we almost have to recalibrate the way that we think about the Fed's policy reaction function now. And I think the key thing here is that they have said that, look, we're committed to making sure that we secure that soft landing that we have in our reach. And this certainly does go some way to proving that.
I think Goolsbee re-emboldened risk quite solidly yesterday when he talked about just how tight rates were and his proclivity towards lower rates. I mean, when you look at what Nomura say, forced re-risking and exposure grabbing, is that what we're seeing in these markets?
I think there is some of that, certainly, because this almost has reset the tone. I think going into last Wednesday, there was some concern that if you get a 50 basis point move, at some point the market is going to retract because it worries what else is in the future. But Powell did a really good job of conveying their confidence in the broad economy. So when you have got rate cuts and you have a steady economy, that is typically really good environment for risk assets. The one caveat to this, though, is that valuations everywhere are very, very expensive. So in terms of how far it can go, when you haven't really had a pullback to clean out the market, I think that's probably the bigger question. But certainly from an exposure perspective, this is really the time to be risk on.
And just in terms of the drawdown, or there's nothing has interrupted us here, you still think that there's more miles in equity rather than credit, rather than, where do you deploy in the near term in this risk on environment?
Right, so we are certainly very much risk on the equity side. I think there is a trade to be had within the small cap space, particularly because valuations have been so cheap, and it is very much that kind of stronger, at least more positive economic environment. Also, though, from a credit perspective, we had been overweight a lot of the core fixed income space, particularly IG coming into Wednesday. I think we almost have to revisit the expectations around high yield, though, as well, because if you are looking at an environment which has a lot more confidence about the economic outlook, then it means that defaults are unlikely to spike. And although credit spreads within high yield are tight, it still does provide you that income without that much risk that maybe had been there last Wednesday.
Look, there's a great debate out there that we're so risk on, we're so FOMO, we're so TINA, that the left tail risk is thoroughly banished. Is it thoroughly banished for you? Is there any hesitation at all?
I don't think it's entirely banished. I mean, I think the number of people who are still long duration with some exposure to treasuries is that caveat that if there is a growth slowdown, which is entirely possible, then you still want to have that safety exposure. I want to say, though, that the China stimulus measures, if it does come through, that does actually it does further improve the outlook globally and particularly for the US, because typically when there has been a global growth slowdown, there has to be some kind of engine of growth from somewhere. And if Fed loosening isn't enough to boost the US economy, but China's policy stimulus is, that could be enough to really improve risk sentiment even further. So I think there's a lot of moving parts to this story today.
Yeah, it's interesting how that China story will wash up, as it were, in the pro-risk story for the US at the same time. Seema, thank you very much. Seema Shah, first reaction there on the stimulus measures and the markets. Other stories trending on your Bloomberg terminal this morning. This is what we got for you. B. Riley's $2 billion debt load has prompted its bankers to hike the interest rate on the company's key loan and cut how much it can borrow. The deal requires the struggling firm to cut the balance on its term loans to $100 million within the next year and eliminates a revolving credit line. The FTC is expected to allow Chevron's $53 billion takeover of Hess. The takeover was announced 11 months ago. The FTC could announce the decision as soon as this week, the time to complete the deal. Chevron still needs to win an arbitration case filed by Exxon and China's CNOOC. The U.S. Justice Department is planning to allege that Visa illegally monopolized the U.S. debit card market. The Antitrust Division is set to file a lawsuit in the federal court, which may come today. The U.S.'s largest payments network stands to be accused of a range of anti-competitive conduct. It includes making exclusive agreements to hinder competing networks from entering the market. Coming up on this show, Cameron Dawson of New Age Wealth, anticipating the Fed move patiently towards neutral. We'll catch up with Cameron a little bit later this hour. And we're live to London to my co-host, Danny Berger. This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center.
And that's news when you want it with Bloomberg News Now. Get it 24/7
on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
It's Bloomberg Brief. I'm Manish Kani in New York. Danny Berger is on assignment. The hedge fund leaders and investors are gathered at Wembley Stadium in London for the 5th annual Liquid Alternatives Summit. Danny sat down with the AQR Capital Management co-founder Cliff Asness.
The bigger question I'm trying to answer is I see this as a sign of the market getting less efficient about pricing. And in principle, we all think things should get more efficient over time. Technology marches on. Data is more available. Things that were available at a lag are available instantly now. But I think most of those things go to speed, not to accurate pricing. Yeah, things get in prices faster. But I think there's strong evidence, so not just these two things, but these are the two major ones I experienced, that the crazy periods are getting crazier and lasting longer. So the next question I ask in the paper, and this is very speculative, I admit, is why? Why? And there are probably other great ones, but I focus on three, and I'll say them really fast.
Sure.
The first is the rise of passive. That's everyone's favorite. Passive has broken the market. I think that is probably part of it. No one knows how many people can actually be passive without breaking the market, but we know it's not 100%. That's a weird world where nobody is thinking about whether NVIDIA is worth more than a candy store.
Yeah.
So the idea that there would be less could weaken the tether to reality.
I want to let you get to the other two,
Sure.
because I find them really interesting. But just in terms of that, especially when we're talking about NVIDIA, and this being a crazy period.
You know quants know nothing about individual stocks,
Of course, you know
right?
nothing about a single stock. I'm very aware of that. How crazy is this period?
We're still, and I won't talk about NVIDIA in particular, but when it comes to the spread between cheap and expensive stocks, we were at a new 100th percentile in COVID. I jokingly call it the 120th percentile, which from my math friends listening to you, there is no such thing. It's just the new 100th. But it was about 20% above the prior 100th. We're back down to about the 80th percentile spread versus history. We still have a little bit of a tilt on, but far smaller than when it was 120. So I would say things are still out of whack, but it's not an arbitrage you can drive a truck through now. But so I think passive is part of it, but it's very hard to know how much. The second one I'll do beyond quick. Post-GFC, 10, 15 years of super low interest rates. I don't think justifies these spreads, and we've written a lot about that. But in a very non-technical sense, may that drive investors mad and to do some crazy things? Yes. That's all I'll say about that. My third and favorite hypothesis, because it's so counterintuitive, is I started out saying technology might make things faster but not more accurate. It might, and in fact, I would argue probably does, contribute to the less accurate pricing. And in particular, I'm talking about the milieu of instant information, free trading, certainly social media. The dot-com bubble was the first go-around of kind of proto-social media, where you're a little too young for this one, but message boards were very hot. People are all discussing their favorite e-toys and drcoop.coms, and if markets are efficient to some degree, not perfect, the wisdom of crowds, the famous idea that a crowd can be more wise than the average component of the crowd, is a huge part of it.
How much of your Twitter interactions color this? Because you're not afraid to talk to, I just, you know, when you're talking to people who you don't agree with online, does some of that color it saying, maybe this crowd isn't so wise?
I hope not. But may it sneak in? I would have to admit it might sneak in. But if a wise crowd is the goal in a market, have we ever had a vehicle better than social media for turning a wise crowd into a dangerous mob? And I'm not going to get political, except I'm not going to choose a political side. But if our politics are not a great example of this, I mean, there was a point 20 years ago where we had utopian views with that social media would make us all like each other more. I don't think I need to convince any of your viewers that that has not happened. And I think a lot of the same has creeped into markets. It's unfair to choose the most crazy example. But a poster child, not a proof, are the U.S. meme stocks. They are the most extreme example of what I'm talking about.
Right.
Crazy valuations driven by social media. But life is not just them and everyone else. It's a point on a spectrum. So I do think markets have gotten somewhat less efficient.
Right.
I think the final interesting question is, what does that mean for a rational style of investing?
Can I ask, because you also
please.
point out in your paper that it's a problem for society.
Yeah.
Why is it a problem for society?
Well, if you're actually going to read the paper, it's going to make this all take longer. You know that, right? It's a problem for society, and I think I'll be a cheerleader for our industry.
Yeah, we got to be quick here, Cliff. Only 30 seconds.
I don't know if enough people think about it this way, but rational prices are very important to a free enterprise society.
Yeah.
When prices are wildly irrational, prices are how we allocate resources.
Yeah.
And we do it in a very unproductive way if companies that are not very productive and are speculative and pie in the sky are getting all the money.
Yeah.
So it matters.
Cliff Aston's there, AQR Capital Management, co-founder, speaking to my co-host, Danny Berger, who is at Wembley Stadium, I think it is. Danny, good morning. Good to see you. Great conversation. Crazy markets, which are not very efficient. That puts the fear of God in me. Good morning.
Yeah. Good morning. And it creates a problem. First of all, Manus, great to see you. Look at this backdrop I'm in. For some reason, they're mowing Wembley Stadium right now. You might hear a little bit of that. There are no trees to speak of. I'm not too sure what that is. But nonetheless, you're right. It's a problem. If markets are less efficient, what does that mean for someone like Cliff Aston? You could kind of hear him opining on it, and he thinks a lot about it in terms of society. He sees the entire crowd, because usually when you invest, you say, okay, markets are somewhat efficient because there's wisdom in the crowd. Cliff Aston thinks that the crowd is no longer wise. That because you can have anyone invest who you want to, you just go on your app, you download whatever your favorite investing app is, you can talk to people about it on Twitter, you get these strange dislocations. You get NVIDIA going to the sky, and you get political environments which become more contentious. So he actually sees those two issues as inextricably linked, which, again, it's an election year, so that's a problem, and he needs to navigate these markets, Manus.
And it's interesting when he talks about whether markets are cheap and expensive and reflecting back in a post-COVID world. And again, it is that debate. We've got lots of notes in our inbox, Danny. Nomura this morning are talking about a forced re-risking, exposure grabbing. Ed Yordeni yesterday talking about melt-up markets. So again, it's trying to define whether we're in some kind of crazy melt-up mode.
And what do you do in that crazy melt-up mode? If you're an asset manager and you have a contention like Cliff Aston does, and he talked to me this morning, that markets would mean revert, that at some point value would play out. He's of course talking his book because AQR is largely a value investor. But what a less efficient market means for him is that those crazy periods last longer, that he really needs to grit down and be convinced in his bet that it will work out. But it gets harder, Manus, because again, it's crazy and maybe you have clients who leave because it doesn't play out. I should say AQR's returns, they have been solid. During COVID, there were some issues, but when that value resurgence started to come back up, AQR did better. But for them, it's a more difficult period. You just got to brace it as the craziness continues.
Embrace the inner crazy. And I like the fact that you were called young. There you go. The defining line. The defining line. Danny, great to see you. We're going to see you a little bit later on, and enjoy your time at Wembley there. Danny's next interview, a little bit later this hour. Fabien Creton, Fou-Meron at Carmignac, fund manager, joins her at Wembley. Coming up in the show, a look at what else is making the headlines around the world this Tuesday morning. We'll discuss Israel's latest airstrikes targeting Hezbollah in Lebanon. Context matters on Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because you know, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics and math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
It's Bloomberg Brief. I'm Manus Cranny in New York. Your front pages, this is what's making headlines around the world. First up on Bloomberg, Israel airstrikes on Lebanon kills hundreds in a major escalation. Nearly 500 people have now been killed in Israel's latest strikes in southern Lebanon, targeting Hezbollah. It is the deadliest bombardment on Lebanon since 2006. Up next, Wall Street Journal leads with Trump. Issues fresh trade threats targeting Deere. The former president threatens to slap a hefty 200% tariff on the farm equipment maker John Deere if he's elected. More on that story a little bit later on. The FT goes with Andrea Orchel, sends Germany into a frenzy. The UniCredit more than doubled its stake in Commerzbank. Berlin is not happy.
What's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google public, so I had a little sneak preview.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Menace Cranny. Let's set your agenda. Embracing the risk on with a message from the Fed. Many more cuts ahead. A stimulus blitz. China unleashes a raft of support measures to shore up growth. And we're 6 weeks away from the U.S. elections. More on the former President Trump's economic agenda coming up in this show. Good morning. Choose your superlative. We continue to trade higher in these equity markets. Is it melt up? Is it FOMO? We've just had a conversation with Chris Asnes of AQR talking about crazy lasting a little bit longer. Nomura warned that we are being forced to re-risk and take exposure. We're grabbing exposure. Nonetheless, these equities are higher this morning. Roll it over, have a look at the bond market, and what you will see is we're getting ready for $69 billion worth of two-year paper to come today. That will be interesting. Yields popped just a little bit higher this morning. The input prices, the highest of 2024 yesterday. But again, the narrative continues from Goolsbee, Kashkari, etc., which is just how tight these rates are at the moment. The building narrative from the street, from BlackRock, PIMCO, BMO, Morgan Stanley is keep on going with the steepeners, and there is a global disinversion taking place in these bond markets. So as I say, the Fed officials are cautious, but they are keeping the door open for another large rate cut. Let's take a listen to what Chicago Fed President Austin Goolsbee had to say.
If conditions continue like this, there are a lot of cuts to come over the next 12 months. There's virtual unanimity about that. So whether the next one is 25 or 50 or 0 or whatever, my view is over the next 12 months, we have a long way to come down to get the interest rate to something like neutral to try to hold the conditions where they are.
Joining me now is Cameron Dawson, CIO of New Edge Wealth. Good morning. Good to see you.
Good morning.
So Goolsbee, I think, went on to qualify a few more things. We're hundreds of basis points away from neutral, and he really focused on how tight real rates were. Is that myopic or hopeful for you?
I think it is rather myopic, because if you look at the empirical data in the economy, it's hard to argue that things are falling off a cliff. GDP growth is still well above trend. You also have a labor market that, yes, it has softened around the edges, but it's broadly still healthy. And then broad financial conditions are still very easy and in stimulative territory. So it's interesting that the Fed continues to focus on financial conditions is in a very narrow sense, which is just looking at real rates. And yes, real rates are elevated, mostly compared to the last cycle. But if you broaden out and include things like credit valuations, credit spreads, look at stock valuations, all of those suggest that financial conditions are loose. So it raises the question of what could the potential ramifications be of doing hundreds of basis points of cuts with this backdrop.
Well, then that's when you really juice the market and the economy. But then it raises the other question, which is perhaps the consensus is correct in the building and that the neutral rate is actually higher than we all think and than what the Fed thinks.
And Powell did say last week that he thinks that the neutral rate is, in quotes, significantly higher than it was in the post-great financial crisis period.
Yeah.
And so if we do see that neutral rate creep higher, it just suggests that there is a higher floor under rates than what is currently being priced. Because the bond market does have us getting to neutral by January of 2026 at the current forecast of about 2.9%. If that continues to creep higher, this says that they won't cut as deep as what the bond market's expecting. The question, of course, would be if the equity market really cares about that. We think at the end of the day, as long as growth holds up, the equity market doesn't really care if they don't get all of the cuts that are currently priced in.
So if the equity market doesn't care that they get all of the cuts priced in, are we in some kind of a forced exposure grabbing narrative, as I said, from Nomura?
It is very much a risk that you see a chase and the potential of a bubble brewing. Let us not forget what happened in 1998 post those cuts following LTCM, where you certainly saw that added bit of liquidity spark a massive bubble that was great in the short run, but highly destabilizing in the long run as the NASDAQ took 14 years to make a new high post the peak in 2000. So that is...
You don't think we're really back in that kind of phase, do you?
We're not there right now, but the risk is that we get there if you add a lot of liquidity. I think you have to appreciate the starting point of high valuations today and high positioning. If you look at household equity positioning, they're still just only about 1 percentage point away from 20-year highs, which just says that how much more is there on the sidelines to be drawn in? The answer to that is leverage, and that's where you would start to get into these questions of destabilization in the medium term.
So it's interesting you talk about the money on the sidelines, because from where I'm sitting, 50 basis points doesn't shift the needle for money markets. 100 basis points, I would say, this is a personal view, I would say 100 basis points really begins to turn the tap from money from the sidelines.
We've often raised the question, though, of how much of money market money will actually flow into the equity market, meaning that is it as fungible as people think, that people are just waiting to get into equities? We think it leans a little bit more into fixed income, of people extending duration. That's much more of a consistent kind of asset class. But to your point, if you continue to see markets melt up and drift higher, that of course sparks a chase, sparks risk-taking activity, which feels really good in the now, but certainly creates risks over the 5-10 year period.
You sound a little bit hesitant. Everybody else is so bullish, right? I know your base case is things are good at the moment, but there's a hesitancy in you about what's going on.
Well, I think that we have to respect the trend in the short term. That has been the key message from this market really since the low in October, is that the market is absolutely defiant that you must respect its trend. And so we're not in a position to want to question that at this point. What we want to say is let's not temper to say that let's take on a bunch of leverage, let's add into positions in a very risk-on way. We think that there's a measured way to continue to have exposure to equity markets. We continue to see upside given the fact that you have this forward earnings estimates that do rise, but we want to be aware of the fact of that the starting point of this easing cycle is incredibly rare, simply because valuations, positioning, and sentiment are all starting very stretched.
Seema Shah was with me just 30 minutes ago, and as she said, look, there's a reset in these markets, and you need to embrace it. And perhaps one way to embrace it with a little bit more upside is that small cap valuations, in her view, remain cheap. So is that a pocket? Everybody talks about it, but is that now where I now deploy a little bit more?
If we think about the setup of the Fed aggressively cutting interest rates and having resilient economic growth, which is boosted by things like China's stimulus today, possibly a lot of fiscal stimulus in the US, that is an environment where small caps have typically done very well. Small caps need two things. They need low rates and strong growth, and that backdrop of a risk-on environment. So because positioning is light, valuations are low, it's certainly fertile ground for a strong snapback. The question is, can it last?
Look, very briefly, you mentioned China there. It was one of our headlines. To what extent does the China stimulus measures wash back up in a pro-USA risk narrative?
I think it has the possibility of lighting a fire under cyclical value. That classic sectors of things like industrials, materials, and energy, areas that have lagged or struggled this year that can get a boost because of higher commodity prices, higher kind of cyclical activity. Those areas seem to be getting a little bit of a lift, at least since the Fed rate cuts were starting to be priced in July in a more aggressive way. I bet that continues given this backdrop from China.
Okay, Cameron, thank you very much. Cameron Dawson there of New Edge Wealth, her take on the markets. Coming up, we'll look at the deal making for the rest of the year. Fabienne Creton-Fumeron of Carmignac Fund Management joins Danny at Wembley Stadium at the Liquid Alternatives Summit. Context matters on Bloomberg.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Bloomberg Brief. I'm Manus Cranny in New York. Good morning to you. Hedge fund managers and investors from across the world are gathering in London for the 5th annual Liquid Alternative Summit. Danny Berger is on tour. She's at Wembley Stadium. Danny, good morning.
Good morning, Manus. Thank you so much. I'm very pleased to say we're going to have a conversation about merger arbitrage. I am here with Fabienne Creton-Fumeron. She is a portfolio manager at Carmignac, who leads the strategy. Wonderful to see you, Fabienne. Thanks for joining this morning.
It's nice to invite me.
So last year and the year before was a little bit slow for public M&A. It has picked up. Just how many more opportunities are there for you now? Is merger arbitrage exciting again?
You're completely right. You know what? We have had like 4 years of declining cycle, declining activity. But since, I would say, last semester of last year, it's picking up. Let me give you just few numbers. Activity in terms of numbers of deals have been picking up by more than 38% compared to last year. And in volume, it's like 30% of increase, with a lot of mega deals being announced. For example, you have Kellogg's, you know, the cereals, being bought by Mars, and that's something like a 30 billion deal. So yes, the activity is back, and it's back in all the regions. US is representing like 55% of the activity. Europe is back. That's great news. Europe is back, 72% of increase compared to last year's, and UK is the most active country, with big deal in beer like Britvic, or well, with huge deal, and the books, WHS with Smith.
Well, part of the freezing up was when you had higher interest rates, the cost of capital was more expensive, less deals were getting done. Now that we've had 50 basis points from the Fed, you've had 25 basis points yet again from the ECB, the cutting cycle has started. How do you expect deal volume to pick up from here on out?
It's always difficult to have a predictive view, but for the moment, the activity is a bit slowed by the FTC scrutiny, and that's a main issue or a main risk that we've seen. Right now, we have 2 major litigation in the US, Capri Tapestry deal in the handbag sector, and in the supermarket, Albertsons Kroger. So the outcome of those 2 litigation will be known like mid to end of October, and this will have a huge impact on 2025 activity.
What sort of impact? Can you get into that? If some of these do end up being blocked and we still see more forceful regulation?
If some deals if those 2 deals gets blocked, and it's always possible, because at the end it's a judge view, then I think we will have deals that are more prepared, we will have less mega deals maybe. So we'll still have activity, I would say, in medium-sized company, but maybe not huge and mega deals. If the 2 deals have green lights, then it's an opportunity for deals to come back. I would say more than the results of the US election.
Okay.
The results of those 2 litigation will have a dramatic impact.
How does it change your strategy, though? Not even just the results of that, but the fact you do get these deals caught up in regulatory crosshairs, that they take longer. What does that mean for you?
You're right. It means that it takes longer. If you go 18 months back, a normal deal will last between 6 to 8 months. Now you can add 4 to 6 months to that duration, meaning that if there's a little bit of overlaps, not huge thing, then you have to think that you will have a second request from the FTC, and then it will last longer. So you have to take that into account. So.
Okay, is that frustrating? I mean, how do you cope with that? Because you put these bets on, you assume these things are going to happen, and you just have to wait. Is it an issue of returns? Is it an issue of your investors saying, okay, we're ready for these things to play out?
It's not really an issue. It's an issue when it's when it takes more time. When we first had the impression that it would take 6 months and it takes 1 year. Now that we know that it will take 18 months, all the spreads and the return have adapted to that time. You see, and there is always something that come up. If we are back last year at the same time, we were focusing on Chinese blocking deals, and now it's on FTC scrutiny. Maybe next year will be EC or CMA scrutiny. We never know. What we have to do is try to take into account all those impacts into the spreads, and we think right now the merger up spread are well adapted to all those new issues.
What about some of these mega deals, specifically around AI? Rumors, not rumors, but reports of Qualcomm looking at Intel, of Apollo investing in Intel, Microsoft buy some nuclear plant. A lot of deals seem to be concentrated around this. In terms of pricing around these types of things, there's so much enthusiasm of it, they can get sky high. How does that change merger arb when it's specifically these types of areas that there's just so much investor enthusiasm around?
maybe you will have a higher premium. There is definitely tech is the biggest sector this year in terms of announced deal. I think it's 16% of the total deal announced are in tech. But we have a focus on that because we like that, right? And because it's the future. But this MS cycle is also composed of the old economy and the new economy. So new economy, as you said, all the biotechs, but also drugs with obesity drugs and a lot of deal in biotechs. And we also have old economy deals like oil, banks, food, consumer staples with Colonna being back by March. So we have, I would say, we don't have only tech, which would be a bit worried, okay? Could be a bit, could be of worries. But we have deal across the sector of various size. It's a very good sign for 2025.
Yeah, the perfect place to leave it. See, it is exciting again.
Yeah.
Wonderful to get the details. Fabian, thank you so much. Really great to speak with you this morning, Manish. That is Fabian Quentin from Ron of Carmignac on M&A. It's back.
Good to hear. That's day 2. We've heard that from Jerry Keefe, and there you've got the validation from you there in Wembley. I am envious. Beautiful backdrop. Have a great day and enjoy the rest of the week. Danny Berger in London on tour at Wembley Stadium. Here in the United States, we're 6 weeks away from, you got it, the elections. The former President Donald Trump says he will tell China to honor its trade deal with the U.S. if he returns to the White House. Here's what he had to say at an event in Pennsylvania.
The first thing I'd do is I would probably, my first call, I'm going to call up President Xi. I'm going to say, you have to honor the deal you made. We made a deal. You'd buy $50 billion worth of American farm product, and I guarantee you he will buy it 100%. He will buy it. Second thing I'm going to do is I'm going to say, you have to give the death penalty to your fentanyl dealers.
Trump has been promising a litany of tax breaks to voters. He's now preparing to outline steps to lure foreign companies to the United States when he speaks in Georgia today. Our senior editor, Michael Shepard, joins me now from Washington. Mike, good morning to you. The latest that we can expect from President Trump, a lot of yesterday was about John Deere, it was about tax. So what is the latest that we can expect?
Well, today Donald Trump is going to lean into what he calls a vision for trying to get even more manufacturing housed here to help turn the U.S. into more of an export engine and export economy than it already is. He is going to propose a series of steps that would allow the U.S. to try to lure more foreign manufacturers to house their operations here. That would include lower corporate tax rates, easier regulations, access to good ports, and to cheap energy. And some of this may have to get congressional approval, and the details are a little light on the plan, of course, but it is part of his vision for trying to boost manufacturing, one that we heard through his first term in office. He is also accompanying this with a familiar stick, and that is tariffs. It's something he talked about yesterday with respect to John Deere, and it's something he is using as a threat to companies who don't buy into this.
Well, let's just listen to what he had to say about John Deere.
I just noticed behind me John Deere tractors. I know a lot about John Deere. I love the company. But as you know, they've announced a few days ago that they're going to move a lot of their manufacturing business to Mexico. I'm just notifying John Deere right now. If you do that, we're putting a 200% tariff on everything that you want to sell into the United States.
Look, this is the classic policy that was used in the last administration. He's also promising corporate America, you know, made in the USA, you get a cheaper tax rate, 15%. But can these levies that he's talking about really go the full way to paying for the significant tax cuts that are being promised?
Well, when we look at the cost of those tax cuts, it totals roughly $13 trillion, nearly what it costs to run the government on an annual basis. And with with those tax cuts combined with tariffs, we don't get even close in terms of tariff revenue, according to analyses by economists. And his opponent in the November election, Kamala Harris, has also seized on a big flaw in Trump's argument. He is trying to maintain that these tariffs will pay for tax cuts and that other countries will be bearing the cost. The truth is, and every economist worth their salt will tell you, that tariffs are paid in the domestic market where they're imposed. So a tariff on a product from China, the cost of that is borne by consumers here in the U.S. The prices get raised here, not in China. So Harris is able to use this, and she did so during the debate earlier this month, saying that, look, this is actually a tax in another name on the American public.
Yeah, I mean, this is where both of them try to draw the deep divide between them in terms of taxation policy for corporates with Trump and versus Harris's taxation policy for corporates and perhaps the wealthier. But let's talk about Harris, because she will be talking more about the economy, and this is where she's on the back foot against Trump in the polls. So what are we going to hear from her that's perhaps going to embolden that position?
Well, Kamala Harris has been gradually unveiling pieces of her economic agenda if she were elected. They include expanding the U.S. housing stock by adding as many as 3 million units nationwide, offering incentives to first-time home buyers. She would pay for this by raising corporate tax rates from 21% currently to 28%. Donald Trump, on the other hand, is calling for lowering corporate taxes to 15%. She is also calling for extending the Trump-era tax cuts on individuals who make less than $400,000. And paying for it also will be a tax on buybacks, for instance. All of this is trying to draw a distinction that she is aiming for the middle class and accusing Trump of aiming more for what she calls his friends in corporate America and Wall Street.
Okay, and of course he is promising no tax on Social Security. It really is grabbing at various pieces of the electorate out there. Mike Shepard on the very latest on the campaign to the White House. Coming up, we'll set you up for the rest of your trading day. Don't forget, a little bit more Fed speak and a 2-year auction. All to play for on Bloomberg. Good morning from New York.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Here's a look at the rest of your day. Fed Governor Michelle Bowman speaks at 9 a.m. Eastern, then the Conference Board Consumer Conference at 10 a.m. And President Biden speaks at the UN General Assembly here in New York. Surveillance is up next. Context Matters from New York every day on Bloomberg. Good morning.
In terms of how we should deal with the challenges that are, facing the world and also internally, I think it's just an opportunity also, an angle. And you could see that in a lot of activities that are picking up in this region, simply because it's a region that is actually a bright spot amongst very few in the world today. And people always talk about the flavor of the month. Actually, I don't want to sound too, large-headed, but actually we will be the flavor of decades. We are determined, we have long-term plans, and we are very clear and committed on our commitment to the investment community at large. I'm not talking about one individual country, but at large in the GCC, that we mean business, that we are willing to take every step possible to make it easier for investors to do business in the region, that we are willing to do a lot of structural changes, including actually making it very predictable, very consistent policies.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Inflation isn't all the way there.
By cutting rates, we may actually get an accelerated decline in inflation.
We think inflation's settling now in a 2.5–3% range. Fed seems okay with that here.
Fed officials are just focusing on what their policy is going to do to the economy without really putting it in the context of the overall economy.
My concern is that we're just making a pit stop in this balanced level on our way to weak.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your trading day started. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now, coming into Tuesday at all-time highs on the S&P 500 and looking to add some weight to the rally. Equity futures right now on the S&P 500 shifting higher by 0.1% on the NASDAQ, up by 0.25%. China unleashing a stimulus package overnight with something for everyone. Let me go through the bullet points here. Cutting interest rates, reducing reserve requirements, lowering borrowing costs on mortgages, and studying setting up a market stabilization fund. Equities having their best day since 2020.
Basically, this is Plunge Protection Patrol coming out and saying we have something for you, and we have something for you if you own a house or if you want to buy a house. Here's the problem. Is this a bazooka, or is this just basically the opening salvos of something that people are going to hope is the beginning of something more? Because ultimately, how do you spur demand for people who don't have confidence about jobs, who don't have confidence about the value of their home, to borrow money if they don't want to buy. And that ultimately is the problem.
Consumers are not spending, especially when layoffs are looming. Capital Economics comes out with a note after this saying basically this is in the right direction, but it's insufficient unless there's going to be that fiscal fire hose coming out of Beijing. What we've been talking about for months is that maybe Beijing, to this Goldman Sachs note over the summer, is waiting to use the fiscal stimulus maybe they have because they want to know what direction the U.S. is going in terms of the election.
What's the opposite of Bramo's toxic brew? A bullish brew. Rate cuts from the Federal Reserve, stimulus package, unleashing the killer doves of the Federal Reserve yesterday. Hello, Chicago Fed President Goolsbee, who thinks we might be hundreds of basis points above neutral, saying over the next 12 months, we have a long way to come down to get the interest rate to something like neutral to try to hold the conditions where they are, opening the door to another big cut at the Federal Reserve.
It's just not realistic to wait until the problems show up. If we want a soft landing, we can't be behind the curve. Thank you, Austin Goolsbee. It is soft landing nirvana, obviously. That is the opposite of toxic
That's the
brew.
opposite. Love that.
Yeah, so it is the soft landing nirvana, and a lot of Fed officials would like to see that continue.
And obviously what you hear from the Fed officials is pretty much inflation is one of yesteryears. They keep talking about they have to lean into the labor market, and they want to reassure that they do no longer see any more weakness when it comes to labor market economy. It feels like a one-mandate Fed.
We'll have plenty of coverage on the Federal Reserve throughout this morning. Plenty of Fed speak for you through the next couple of days. Some coverage as well on one single name, Deere. Deere caught in the headlights. Donald Trump going after that company big time overnight.
Basically saying if they move any of their manufacturing to Mexico, he's going to have tariffs on them. I think he said upward of 200%. What I took away from this is you're starting to see the former president fill in some of the gaps. Maybe not all of this he's going to do, but the direction of travel. He said at the Economic Club of New York recently that you will only get that 15% corporate tax rate if you produce in the United States. And now he's basically saying not only will you get that carrot approach, but the stick will be if you decide to move outside of the United States, you're going to get hit with tariffs.
All I can think about is that we're going to get some economic speech today from Donald Trump. Is it going to be like, dear, I have an issue with you. You know, we're going to have a question about where our coal is. We're going to have a question about this particular company over here. Is it going to be like that? Is it going to be like there are no more taxes? I mean, these are some of the questions that people have going into today.
Yelena Shuletseva of BNP Paribas was on this program a week ago and made the point that maybe the pullback in hiring recently is down to the election. And I wonder how many companies are out there, like Deere, who are reluctant to make big decisions right now, including investment decisions like this one, because they worry that there could be a change in the White House and they know there will be consequences.
And at the same time, they're finding their overhead costs too onerous. So that's why they wanted to build a plant in Mexico, because the costs were so high they were having to cut jobs in the U.S. It's a complicated story, so why make a bold move and sort of complicate it even further, given some of the potential changes?
And no one wants to be a football on the campaign trail, right? No one wants to be that, and that's what Deere is right now.
Maybe Nippon Steel wants to be a political football?
I don't know why they're electing to become one.
I know, essentially, that's the question. I do find it interesting that a couple of deals are actually getting through suddenly, which makes me wonder if there's sort of a nod to business from this administration on sort of the twilight of his campaign.
Deere, just about unchanged in the pre-market right now. For broader equities, we're positive by almost 0.2% on the S&P 500. In the bond market, yields are a little bit higher, up 4 basis points on a 10-year, approaching 380 at 379.25. The 10-year yield climbing for 6th consecutive sessions. Just a slow grind higher over the past week.
Just rest in peace, all of those yield curve inversions, because they're all gone. And this comes as you do see the U.S. yields on the long end climbing higher. Is this basically a note of confidence, a return to normalcy, or is this just a hint of something else? That maybe if the Fed is, super dove mode, that you end up with some longer term inflation or growth that end up getting expressed in potentially higher longer term yields.
The 2-year, 10-year spread approaching 20 basis points on the screen right now. Coming up this hour, we'll catch up with Brian Levitt of Invesco, with stocks returning to record highs. Julie Norman of UCL on the risks of an all-out war in Lebanon. And we'll speak to Kamakshai Trivedi of Goldman Sachs on China's stimulus package. We begin the hour with stocks returning to record highs on bets the Fed will deliver another big rate cut. Brian Levitt of Invesco saying the US stock market has historically posted strong returns after the start of an easing cycle if the economy didn't fall into a recession within the next 12 months or if it was already in a recession. Brian joins us now for more. Brian, good morning to you.
Good morning.
How bullish are you this morning? Rate cuts from the Fed, stimulus from China, what's not to like?
There's plenty to like, and Soft Landing Nirvana, that's one of my favorite early 90s cover bands on grunge music. So no, there is a lot to like. I mean, this basically all comes down to the resiliency of the economy. When you say it's a one-issue Fed now, that's because inflation's passé. Now, when I say that to most Americans, they think I'm talking about the high cost of living. I'm not. Of course, I'm talking about the change in the rate of change. So inflation's in the comfort zone. The economy has been slowing. We've been talking about leading indicators of the economy are pointing to a slowdown. So you needed the Fed to step forward, and they are. And the market's focused on the rate cuts now. And so long as we continue to see relative resiliency in the economy, then it's bullish for markets.
Stocks will do well if the economy holds up. That's your general message.
That's the
Job growth
general
has
message.
slowed. You acknowledge that.
Yeah.
A layoff's not inevitable once jobs growth starts to slow to the extent that it has over the last few months.
Well, it's a little bit of a race between the Fed and the unemployment rate right now for the stock market. And so I think every payroll number becomes increasingly more important. But the good news about this cycle, unlike past, usually when you're coming towards the end of the cycle, you have a lot of leverage, a lot of excess in the economy. That's not really the case this time. If you remember, we didn't have enough inventory. We haven't built enough homes. So it's not a classic story of excess. Rather, it's just a bizarre environment where we got inflation early because there was too much money in people's pockets at the exact moment that businesses cut inventory and slashed workers. So you got a bizarre inflation environment. The Fed stamped it out, but the higher rates haven't really hurt most Americans because most of us have fixed rate mortgages. So if we were heading into a recession, I would think corporate bond spreads would be blowing out. The bankers would be tightening lending standards significantly. That's not what we're seeing. And so you're getting rate cuts in a resilient economic environment, which, again, historically is good for stocks.
We should have put a trigger warning on your last comment that most people have low rate mortgages baked in, because some people don't, and they're very respectful about it. I just want to point that out. And I will also
some
say
tension
that
around this
there is some tension.
So present companies somewhat excluded.
Not all of it, but anyway, moving forward. You talk about the situation where you could get ongoing melt up, sort of FOMO kind of. It smells like Team FOMO. But is that sort of what you're leaning into still, or is there a sense around the edges that valuations have gotten so elevated that you have to kind of be a little careful in certain pockets?
Valuations have never been great timing tools. So valuations give you more information about the next 5 and 10 years rather than in the short term. So I wouldn't consider valuations to be a detractor from markets heading higher. The other thing is, as we all know, markets had gotten concentrated. So the higher valuations were concentrated at the top. The average S&P 500 stock or an equal weight index are not particularly overvalued, and you lower the discount rate, it is supportive for valuation. So yeah, I think the markets, if you look historically, look, the reality is none of us want a recession, okay? 80, 81 is your hard landing, and yet if you invested when inflation peaked or the Fed was done tightening, you were happy over the next 3 to 5 years. You just had to deal with a recession in the short term. We would all prefer 94, 95, where you don't have to deal with a recession. You were happy over the next 3 and 5 years. So I think those two scenarios are very applicable in that either way, once you got to peak inflation, peak tightening, you were positive in stocks over the subsequent years. The big difference is, do you have to go down 20% and have people lose jobs in the interim? And that's a really bad outcome. The base case still doesn't call for that, but I'd be optimistic on stocks over the next intermediate period either way.
Probably because of the Fed put, in part, which is part of what's getting people pretty excited.
Don't fight the Fed.
I mean, that's what a lot of people are saying. I am curious, you talk about stocks. One of the most interesting aspects of this cycle is a question about whether long bonds will perform, given what we're facing with the election, given some questions about longer term inflation. You say that bonds have typically outperformed when you start to see interest rates come down, particularly on the long end. Is it this time different?
Well, I think the long end has had a lot of its performance now. So, you go from 5% to 375 or wherever we are today on the 10-year. That's a lot of performance. And if you think about the 10-year, it should reflect the nominal growth potential of the country. So 3.75, 4% seems reasonable. You know, when Austin Goolsby's talking about the neutral rate, you know, the neutral rate is probably somewhere around there. And then if you have to ease beyond that, if the economy gets weaker, then you would expect short rates to go further. So I think the 10-year has done a pretty good job of reflecting the nominal growth potential of the country at this point. The question now is how much lower do short rates have to go? And I'm with Goolsby. I mean, 5.25 was way too tight given the inflation backdrop and the rolling over of leading economic indicators. I was happy with 50 basis points. I've been telling clients, I'm calling the Fed, I'm telling them they're too tight. Nobody's answering my phone calls, but it is, they finally answered. It only took 6 months.
So Brian, are you expecting 25 or another 50?
Well, we'll see. I mean, I don't know. I don't know that it necessarily matters for markets per se. I mean, again, I'm focusing on the resilience of the economy. I believe that we will be at 3.5 on the funds rate in 2025. And if the economy weakens beyond that, then lower than that.
What do you think could make the economy weaken? Is there concern about a reacceleration of inflation, or could this be a policy error maybe on the fiscal side?
Well, I don't think it's inflation. You know, again, I'm one of these, you know, sometimes people get upset with me when I say that. They say, what did that glass of wine cost you? $20, right? Well, but it also cost me $20 last year. So the rate of change is zero. People worry about the high cost of living. So I don't think this is an inflation problem. There's a lot of structural forces against inflation. Rather, it's a consumer that has already shown themselves a pretty good time and is slowing down a bit. You're seeing that at the high. Louis Vuitton's talking about it. Dollar Tree's talking about it. So the consumer is moderating. It's not a terrible thing. This is what we were hoping for when inflation was 10%. So sometimes you got to be careful what you wish for. You know, what slows us down? We've had a prolonged period of higher rates. Most people with fixed rate loans haven't been impacted by it, but credit card loans have gone up, auto loans. These things slowed down the economy. What's your soft landing scenario? Consumer net worth's at an all-time high. Gasoline prices are back to 3. So I don't think it's a cratering. It's a slowdown, and lower rates should help to reinvigorate that a bit.
Next up, payrolls, jobs report 2 Fridays away. What's bullish for you? What makes you uncomfortable? Can you give us an idea of that?
I think what would make me uncomfortable is if it's weaker than we expect, given how long policy has been tight. I don't think we're at a spot where we're going to have a blowout number and all of a sudden we're going to be focusing on inflation again. I ask investors to look at the break-evens. The bond market tends to know these things, and break-evens 1 and 3 are historically low, the bond market's expectation for inflation. So I don't think it's an inflation story, and now we're laser focused on growth. And, you know, like the Fed, perhaps I'm a one mandate person now.
Let's hope growth holds up. Brian, it's good to see you.
Good to see you, sir. Thank you.
Brian Levitt of Invesco. Equity futures right now on the S&P 500 up by 0.2%, with an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Boeing is offering striking workers a 30% pay bump. The company said the terms are final and only valid until the end of Friday, ratcheting up pressure on workers to accept. Meanwhile, the union president saying his team was blindsided by the offer, and the union has no intention of putting it before rank and file members. The proposal is an improvement over the initial 25% increase workers turned down earlier this month, but still less than the 40% initially sought by the union. OpenAI's largest rival, Anthropic, has started talking to investors about raising capital in a deal that could value the startup at up to $40 billion. Sources say this would roughly double its valuation from a funding round that closed earlier this year. The Anthropic talks are ongoing, and it's not clear whether investors will agree to such a high valuation. Anthropic declined to comment. And Elon Musk's America PAC is hiring door knockers across 16 states to help get Donald Trump elected. The jobs are in cities and towns in the heart of presidential battlegrounds and in districts with competitive congressional races, including Grand Rapids, Michigan, and Poughkeepsie, New York. Musk's super PAC has spent $63 million so far in its effort to return Trump to the White House. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, Deere in the headlights.
They've announced a few days ago that they're going to move a lot of their manufacturing business to Mexico. I'm just notifying John Deere right now. If you do that, we're putting a 200% tariff on everything that you want to sell into the United States.
That conversation just around the corner, live from New York City this morning. Good morning.
We spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Coming off the back of a big day of gains over in China, the biggest day of gains going back to 2020, the CSI 300 up by more than 4 full percentage points. This is your carry through. The spillover into the United States, futures up by 0.2%, yields higher by 4 basis points on a 10-year. Rate cuts from the Fed last week, stimulus from China this week. The euro showing some signs of life, and the commodity screen lit up green. A big rally in base metals.
I hope that maybe this is the opening salvo or one of the salvos before China unleashes some more spending, a recognition that they are concerned about meeting that 5% growth target and that they are willing to take steps to get there.
How do you think people react to this later on today? Seen this movie before, same kind of steps, waiting for something fresh, looking for fiscal stimulus, we're not getting it?
This, to me, I was thinking a lot about this morning. This highlights the limits of monetary policy. You can cut rates all you want. You can bring a horse to water, but can you make them drink? It's sort of that kind of analogy, given the fact that people don't have confidence in the economy. So why would they buy homes? Why would they go out and buy expensive goods? And that's the reason why you see the longest streak of deflation, and I think about 5 quarters in China.
The kind of thing you're talking about, the classic elements of a balance sheet recession, which is something we discussed on this program just yesterday. Under surveillance this morning, Deere in the headlights.
I know a lot about John Deere. I love the company, but as you know, they've announced a few days ago that they're going to move a lot of their manufacturing business to Mexico. I'm just notifying John Deere right now. If you do that, we're putting a 200% tariff on everything that you want to sell into the United States. They think they're going to make product cheaper in Mexico and then sell it in for the same prices they did before, make a lot of money by getting rid of our labor and our jobs.
Here's the latest this morning. Donald Trump cautioning the world's top farm machinery maker against outsourcing manufacturing, following reports that John Deere is buying land in Mexico to shift some production there. Sources telling us here at Bloomberg that Trump will outline more incentives for U.S. jobs at an event in Georgia later on today. Bloomberg's Mike Shepard joins us now from the nation's capital in Washington. Mike, walk us through how Washington reacted to those words from the former president of the United States.
Well, in a way, it is the Trump playbook, and even John Deere, an iconic manufacturer of green and yellow tractors, They are not immune to Trump on this front either. It is also just straight out of Trump's playbook. Tariffs are an answer for everything when it comes to economic policy. It was a big fixture during his time in office, and he has made tariffs an even bigger part of the economic plan and vision that he is presenting to the American public as a reason to bring him back to office. He wants to establish the U.S. as even more of a pole for economic production and exports. And he is offering, later today, we'll be hearing from him when he goes to Savannah, Georgia, a vision for ways to lure foreign companies to base their manufacturing operations here. It will include some incentives like lower corporate tax rates and easier regulations, but it will also come with a stick too, in addition to those carrots, the threat of tariffs to companies that don't play ball.
Shep, when it comes to the idea of these tariffs, Trump also said he doesn't need Congress, but they'll approve it. He said, I have the right to impose them myself unilaterally, but if they don't, I'd rather get their support. What did he mean by this? He can walk in and impose tariffs on day one. What is he talking about when he says, I'd rather get congressional support?
I think he wants some air cover from Congress politically to do this, because what we know about economic policy and tariffs is that it is not the countries of origin that are paying the price of these tariffs. It is consumers and businesses here that ultimately have to pay the difference. And that is something that they have glossed over in terms of presenting this to the American public. And it is something that Kamala Harris, his opponent in the November election, is seizing on and pointing to the tariff plans as a tax increase in effect on the American public. So he is trying to indicate that he wants congressional support for that. And also for a lot of the tax proposals he has on the table, he will need congressional buy-in. And he has a whole bunch of things on the table, and it's unclear that Congress would go for the full slate of them.
Kamala Harris continues to talk about in her campaign, the vice presidential campaign, talk about this idea of tariffs as sales tax, but they don't really use the word tariffs. Is that because this administration kept the Trump-era tariffs on when it comes to places like China?
In part, but I also think it's a way of painting Trump into a corner on this, because they are also offering their own vision on tax policy, and it would include preserving the Trump-era tax cuts on individuals making less than $400,000 a year. And it would also include raising the corporate tax rate to 28% from the current 21%. That's still less than what the Biden administration has called for in previous budget requests, but it is more than what Trump has called for in terms of taxing corporations. He's proposing a 15% corporate tax rate. So what she's trying to do is draw this distinction and cast it as tax policy and not really get into the tariff debate, because as you said, Anne-Marie, they have also made use of tariffs by preserving the Trump-era levies on Chinese goods.
Mike, I gotta say, I keep thinking about when mom and dad are angry, especially if they're angry at another sibling. You go in the other room, you hide, you pretend that maybe you're not there, you try not to show make waves. It feels like, to John's point earlier, why wouldn't every company do the same? Why would they make any big moves whatsoever ahead of understanding that everything's calmed down and they'll stop paying attention, which is essentially what people expect to happen once this campaign cycle is over? Is that basically the tone that you're hearing?
Well, look, during the Trump administration, we did see him from time to time single out companies over corporate policies that he did not like. And he would also single out companies that made a move that really he thought was favorable. He had a different kind of embrace and relationship with corporate America than the Biden administration does right now. It's a little bit more arm's length. And with that proximity, there is some risk. So they really don't want to get caught in the headlights of Trump the wrong way. And they definitely don't want to be seen as running afoul of him before the election, because that just creates the prospect of a target being painted on their back, right at the moment they least want it.
Nobody wants to be that person right now. Shep, thank you. Michael Shepard there of Bloomberg. We talked about friendshoring repeatedly. I think the former president does not consider Mexico to be a friend based on that.
Well, who is a friend? I guess that becomes a question, and it's a legitimate question. You think about companies that are trying to rejigger their supply chains to create more security, have any long-term plans. How do you do that? How do you cut costs to face off with some of the inflationary headwinds? It just raises this question that you raised earlier. How many companies are holding off on hiring plans, not to mention mergers and acquisitions, just to get some more certainty on the political landscape?
I think it would be foolish to make any announcements ahead of November, wouldn't it?
I would agree with that. I think that we see that in cold relief.
Borderline reckless.
Are you calling someone reckless?
Absolutely not. Up next on the program, Julie Norman of UCL on the risk of an all-out war in the Middle East. That conversation just around the corner. Futures positive by 0.2% on the S&P from New York. This is Bloomberg.
Many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
We're adding to all-time highs on the S&P 500, up by 0.2% this morning. Good morning to you all. On the Nasdaq, up 0.33%. On a Russell, up by 0.4. You're getting the perfect mix, the opposite of Bramo's toxic brew. What are we calling this?
Soft landing in Nirvana.
Okay, rate cuts out of the Federal Reserve, stimulus out of China. What do you get in the bond market? Steeper curves and higher yields on a 10-year, up for a 6th consecutive session, up by 4 basis points on a 10-year this morning, 378.68. In the commodity market, we start to rally. Look at this, crude up by 2.7%, a pickup in copper up by more than 2%, iron ore getting up off the floor, up by 1.8% in the commodity market.
It's a good way of putting it. Basically, we're seeing a bit of a pop, although more so in copper and a little bit more in oil, as you look toward China, the potential for some sort of stimulus that is, in addition to some of the rate cuts, potentially coming down the pike, a recognition of them trying to get to 5% growth and how much that is going to be a challenge. You do wonder, how do you strip out some of the commodity issues with what we're seeing in the Middle East? And this is always kind of a messy game. But Halima Croft of RBC coming out and saying, this market is not priced for any kind of escalation, and that certainly seems like a likely case as we see that conflict percolating.
This market's been ignoring it for so long. Brent crude around 76 this morning. I'm reminded of something Max Kenner of HSBC said yesterday. With the likely more aggressive pace of Fed and perhaps global rate cuts, throw in China this morning, there could be a non-negligible risk of a growth pickup and threat to the disinflationary progress in the coming quarters. Is that the brand new risk over the last week?
It's the underpriced risk. I don't know if it's the actual risk, and that's sort of what people are gauging. It is underpriced, but is it underpriced for a reason? This from Bank of America derivative strategists. With the Fed's 50 basis point cut communicating confidence that inflation is under control, the Fed put is back with a strike price as high as it's been since COVID. So at a certain point, you could see how stocks could rally even if bonds wrestle with this question about whether we're now underpricing growth and inflation longer term.
That's the latest in a price action. Let's get some of the details out of China. Under surveillance this morning, China unleashing a wide-ranging stimulus package, the PBOC cutting short-term interest rates and existing mortgage rates while slashing minimum down payments for housing as well. Talk of a market stabilization fund as well. They threw everything at this overnight. The CSI 300 up by more than 4%.
Plunge Protection Patrol. This typically comes out if they're talking about potentially supporting stocks. I believe that the stock market is down some 40% since its all-time high in 2021. So you're looking at a market that's very much flat on its back. New home prices, just to give you a sense of where they're coming from, they had their biggest decline last month versus the prior period since 2014. You're seeing outright deflation in a way that we haven't seen since the end of the 1990s. You're facing an economy that really is struggling with consumer confidence. As you start to wonder, what can rate cuts do? And that ultimately is the reason why people are saying this is the opening salvo to something bigger.
And not only are they coming out with everything they have, they're also projecting more to come. The central banker is saying, if we need to, we will cut again. But you hit the nail on the head. The problem is people are not borrowing money, regardless of where the interest rates is, because they're nervous they will not have the sales to make up, to repeat those loans.
Already said it once this morning, classic balance sheet recession. Lowering rates doesn't get it done. You need to boost demand elsewhere.
Okay, be kind to me with this one. I know I'm going to get some heat.
No, please do.
Okay.
Heat from who?
The people. There is this feeling that maybe, this is the reason why the Fed's being so aggressive right now. To the Austin Goolsbee haters out there, and there are plenty of them, I've heard from you all on Twitter, there is this question about whether this is what the Fed is trying to avoid, some sort of deflationary spiral that ends up in a confidence issue. The problem is this is a fiscal issue as much as it is a monetary policy. And so this is sort of the conflict with creating monetary solutions to ultimately fiscal and policy questions.
On the right path, cited the wrong central banker. Governor Waller. I think Governor Waller in the last week worried about undershooting the inflation target.
All right, Professor Farrow.
Don't you feel that way?
I do. I agree. I'm just saying, the most extreme version of the Federal Reserve. I mean, I'm not saying he's making the best argument for it. I'm just saying, that's what he's afraid of, maybe, more than seeing something in the economy.
I'm just suggesting that Governor Waller won't get people's backs up quite like citing President Goolsbee said, the Chicago Fed. I'm not sure anyone wants me to be a teacher either. Let's just get to a different story. Donald Trump threatening a 200% tariff on John Deere products if the company moves production to Mexico. The company responding in a statement saying it's committed to domestic manufacturing with billions invested in U.S. plants since 2019. You can file their reaction under things you never have to want to say. You do not want to get into this game with the former president. They are not in a good spot right now. Just back away.
Absolutely not. I'm not sure why, to your point earlier, businesses are coming out and talking about potentially future plans in the middle of an election cycle when everything is highly politicized. But the issue facing John Deere, Elisa, you brought this up earlier, this is high cost they're dealing with. They want to have more efficiencies across their supply chain, and they're saying they can do that better in Mexico. I have a question. What happened to the USMCA? Donald Trump threw out NAFTA and said, this is now the greatest trade deal. Well, Mexico was part of that.
Yeah, I just can't get over how much, if I were a company, I'd be hiding in a closet.
Big time.
And I just think that you're absolutely spot on when you say, why would you be making big moves of any type? And what if you don't like where the people are being hired from, or potential people who have certain kinds of visas, and suddenly you could become the crosshairs of some kind of political speech? You don't want that.
Yeah, I'd be telling my CEO just to get out of the press right now. No thought leadership speeches, just back away.
Totally.
You know?
Please, this is where thought leadership comes to die.
Just back away. Let's regroup in the new year in Davos, Switzerland, then we can have some happy talk.
Please.
All right.
And we'll interview you.
Let's get to this one. The FTC set to clear Chevron's $53 billion takeover of Hess in what could be one of the largest oil deals in recent years. The company's first announcing plans to merge 11 months ago, with sources saying a decision could come as soon as this week.
This might annoy some Democrats in Washington who were basically sounding alarm. They didn't want to see a mega merger in the oil and gas world. But the issue is this deal is not done yet until Chevron wins that arbitration case. Basically, Chevron wants Hess's access to this deal in Guyana. Unless they get that, they don't want this deal to go through. So it's almost there, but they have to win that arbitration case.
Do you think someone's calling Lena Khan up and saying, you know, you're becoming kind of a big campaign issue for businesses? Maybe just lighten up a little bit around the edges. I mean, really, I'm actually serious, because this is an oil patch deal. And in a previous iteration of the Biden campaign, which is now the Harris campaign, you would imagine that this would be a problem, right? We don't want big oil getting bigger. We're trying to cater to certain constituents, but that's not really the tone now, because it's shifted. So I just wonder how much people are saying, you know,
the only thing the oil industry has on their side is that this is a global market. Prices are made every single day. So how much could colluding there really be?
I think Lena Khan has made some good points over the last few years. My confusion, I think a lot of people might share this, the lack of clarity in this country right now on what kind of deal is allowed and what kind of deal is not allowed, I think it's incredibly difficult to figure that out. And we should know. There should be some level, some degree of consistency on that front, and I'm not sure there is.
The handbags really got you.
Yeah, that did get me.
It was
big
just,
time.
you know, Coach, really?
She was on 60 Minutes, I think recently, and said something about asthma inhalers and made some really, really good points that I think a lot of people would get on board with. Valid. But then it comes to luxury handbags, you've lost me. You've totally lost me. What's that about? What are we doing here? What's the focus? What's the objective?
There would be actually a really important conversation that needs to be had about what competition is healthy and what competition is unhealthy, and specific standards that companies could look to be used as some sort of template going forward. And I think that that would be very wise, and I think a lot of people would welcome that.
Precisely. You put it better than I did. I think what business wants is just consistency. They just want to understand the laws of the world, the laws of the country, and then they can move forward with that. And I'm not sure there's a deeper understanding of that at all. Chevron's up by 0.8%. Let's get you some news, some important news elsewhere. Israel launching airstrikes on targets across southern Lebanon in one of the deadliest days of fighting in nearly 2 decades. Lebanese officials saying nearly 500 people are dead and more than 1,600 were wounded. Bloomberg's Jemana Basechi, helping to lead our coverage out of the region, joins us this morning from London. Jemana, good morning. Can you walk us through the latest and the degree of escalation we've seen in the past few days?
Yeah, I think the most important thing to note is that in the past week, we have seen a serious change of calculus in how this border is being treated. Up until a week ago, you could say that both Israel and Hezbollah were sort of conducting themselves within rules of engagement around a 10-20 kilometer radius away from the border. But things have dramatically stepped up in the last week, from those telecommunication device explosions culminating in the airstrikes across Lebanon, not just in southern Lebanon yesterday, but within Beirut and also the eastern Bekaa, which is close to the Syrian border. And the Israeli military has said that they targeted more than 1,300 Hezbollah military targets yesterday, including rocket launchers and munitions, weapons depots. But the Lebanese health ministry, by the end of the day, had put up the death toll of more than 500 people having been killed during the day of these very deadly airstrikes, 58 women, 35 children, included in that total number, more than 1,600 people wounded as well. So lots of concerns within Lebanon about that rising number of civilian casualties. And of course, earlier in the day, the IDF did send warnings to Lebanese residents to move away from their homes, to evacuate as soon as they possibly could in anticipation of these airstrikes. But for many, that was not a possibility. And what you did see was hours-long traffic jams of people and families trying to evacuate their homes to move up towards safer parts of the country. Now, Hezbollah, in an act of defiance, and even though they have been subject to multiple blows over the last week, many of their senior military commanders have been taken out, they also launched rocket fire into northern Israel yesterday. Sirens went off in Haifa. Now, most of those rockets were intercepted, but the point here is that even though the group and the Iran-backed group has received very heavy blows from the Israeli military over the past week, they're also showing and displaying a lot of defiance here by continuing to fire rockets into northern Israel. And you have to take this back to comments that the defense minister made a week ago, and that the center of gravity has shifted to the north. There is a new war objective now for Israel, and what they want to do is to ensure the safety of the border around the north so that residents can return back to their homes. So as long as there's an exchange of rocket fire, that war objective is not going to be achieved, hence why this continuing round of escalation.
A big shift in the past few weeks. Jemana, thank you. Jemana Pasechi there out of London. Julie Norman joins us now, the director of the Centre on US Politics at University College London. Julie, I want to talk about whether this is a war or not and how relevant that question even is at this point. We hear this all the time. We're on the brink of all-out war. And then we look at the screen and that sure looks like war to me. What is it?
Well, I think that's exactly right. The escalation that we've seen really can't be described in any other terms when we're looking at casualty numbers, over 500 and, thousands displaced and whatnot. I think where some of the concern is around language, but more around facts on the ground, is to what degree is this going to escalate? And I think there's a couple of different ways to think about that. First, if this is going to extend beyond airstrikes to some kind of ground invasion. So far, Israel seems to be preferring the airstrikes, not wanting the ground invasion. They have done that in the past and have gotten bogged down very quickly and for very long periods. So that's kind of option one. Second is drawing in other regional actors. If Iran gets directly involved, if other proxy groups get directly involved. And third is if, by extension, the U.S., other actors need to get involved as well. The Pentagon is already sending additional U.S. military personnel to the region in very small numbers right now and mainly for deterrence purposes. But this is why everything is on this edge of the knife. And I think it's this idea of, is this going to become an all-consuming regional war that, everyone is very concerned about that, as well as the dynamics within Lebanon and Israel.
Julie, when it comes to the potential ground invasion, a senior U.S. official briefing us reporters last night was actually also talking about the fact that it's important to take Israel seriously, though, on their preparations for that. And the other question we've been asking through the course of the past few weeks was, especially when the pagers were blowing up in Lebanon, was this escalation to escalate or escalation to de-escalate? Can you now draw the conclusion that this was escalation to escalate?
Well, what I would say is I think anyone who has spent time in Israel since October 7th has known that, from Israel's point of view, they want to push Hezbollah back. And there were U.S. attempts to do that diplomatically, French attempts to do that diplomatically. But there was always this messaging in Israel that, look, if diplomacy wasn't going to work, Israel was going to take action to push Hezbollah back and take action into their own hands. So I think you can read these current actions in two ways. One is, again, trying to force some kind of capitulation from Hezbollah. I don't see that happening. Hezbollah has been very defiant, especially with the lack of a ceasefire in Gaza. And so the other option is, again, escalation, which Israel is also very prepared for. So from my sense and talking to people in the region, Israel was prepared for it to go either of those two ways. What they did feel was that the status quo was unsustainable.
How long would it take before Iran gets directly involved?
It's a good question. I mean, an interesting thing is that of all actors, I would say Iran is one who really does not want a regional war as well. Back channels with the U.S. have affirmed that throughout. And I would say most notably when a Hamas official was assassinated directly in Iran, Iran still has not really retaliated, taken action back from that. So we've seen elements of restraint there. With that said, Hezbollah is the most important proxy actor for Hezbollah, or for Iran. It's really their strongest asset in the region. And so if Hezbollah is really, on the brink of, of defeat or of really getting hit hard, it would be very hard for Iran to sit this one out and just let their, their main force in the region take that big of a hit. So the pressure is going to be on them as well.
Julie, appreciate your time as always and the update. Julie Norman there of UCL. If you came down from Mars and you went into the Middle East right now, you'd call this a regional war, wouldn't you? Based on what you're seeing on the ground. That's what it looks like.
It is a war. I don't know what people are looking for in terms of escalation. I think that the real questions right now are what kind of escalation is likely? What kind of escalation would bring getting out of control in a way that's very difficult? And really, where are the nodes of leverage right now? Because right now, it doesn't seem like the U.S. has much, and I don't know how much Iran has actually leverage right now over Hezbollah. I mean, they have a lot of leverage, but how much they're actually directing them versus trying to manage a conflict that they clearly don't want to escalate.
Certainly this White House has struggled to influence events on the ground. That's for sure. That's evident over the last few years. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Italian government officials are growing frustrated at Germany's opposition to a potential takeover of Commerzbank by Milan-based Unicredit. According to people familiar, officials in the Italian Prime Minister's administration have privately criticized that while Berlin advocates for more European integration, they then come out against the potential takeover of one European bank by another. Those familiar also say some in Rome have expressed frustration at Unicredit's CEO for being overly aggressive in his bid for Commerzbank. About 45,000 dock workers at every major port along the U.S. eastern and Gulf coasts are threatening to strike next month, just weeks ahead of the presidential election. A work stoppage could lead to supply chain disruptions not seen since the pandemic. One estimate says a week-long strike could cost the economy $7.5 billion. Talks have been at a stalemate since June. Meanwhile, shares of Visa falling in the pre-market. Bloomberg reporting that the U.S. Justice Department is planning to file a lawsuit against the company as early as today. Sources say the DOJ Antitrust Division will allege that Visa illegally monopolized the U.S. debit card market by taking steps to keep rivals from challenging its dominance. The government's allegations include that Visa made exclusive agreements to hinder the expansion of competing networks and thwarted efforts by technology companies to enter the market. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara again in about 30 minutes' time. Up next on the program, China unleashing a stimulus blitz.
I think to deliver this year's growth target may be not that hard given today's policy announcement. And don't forget, we still could have further fiscal stimulus.
We'll get the view from Goldman Sachs up next.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
DOJ or other
authorities.
Could face bigger challenges next.
Fed was going to keep real World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Dare I say it, an inflationary tone to the tape today. Equities up, commodities rallying, curves are steeper, yields are higher, up 3 basis points, 378.30 on a 10-year. I know it might be a stretch at this point. Bold, I know, but it's kind of happening on the screen at the moment. Just at the moment, just as an observation.
Check out gold. I mean, you see it all-time highs on a nominal basis. Look, I agree with you, but on a relative basis, it's still not necessarily, we're talking, you know, little bit incremental of an increase.
Just on the margin, under surveillance this morning, China unleashing a stimulus blitz.
I think to deliver this year's growth target may be not that hard given today's policy announcement. And don't forget, we still could have further fiscal stimulus. Today, there's probably no point of announcing that yet because we still have more than 1 trillion quota left to be basically used up this year. And there's still possibility, if needed, the Ministry of Finance can issue more treasury bonds.
So here's the latest. China's central bank unveiling a stimulus package, sending stocks to their best day in China since 2020. The plan including a cut to short-term interest rates and a reduction in reserve requirements for banks. Officials there also studying setting up a market stabilization fund. Ahead of the move, Kamaksha Trivedi of Goldman Sachs writing, our China economics team have just revised down their 24 GDP growth forecast to 4.7% from 4.9. As such, we expect the Chinese currency to underperform. Kamaksha joins us now from London for more. Kamaksha, you wrote that before this stimulus package, and I have to ask you, is this enough to change your mind?
Look, I think, you know, the stimulus is certainly more than we expected just a few days ago, so I think that's fair and I think that matters. But it seems to me more aimed at putting a floor under the equity market rather than necessarily buoying the currency. And so, yes, of course, we've had a little bit of a currency strength today. We've had more of it in the last, you know, I would say, you know, month and a half, although I think that has more to do with dollar weakness than China's specific strength. So I think, you know, the jury's out. I think, you know, it's not surprising to see stocks react positively to the announcements that you've seen. I still don't think a stronger currency is the best way to express a view on the developments that have occurred overnight.
So there is this question about whether the Fed is opening the door to some sort of stimulus and a further easing around the world, and whether it creates a relative, I don't want to say race to the bottom, but it gives us a bit of a backdrop that could limit how much dollar weakness there could be. Is that kind of your view of things?
I think that's very much in line with our thinking, right? The Fed is a big deal, the fact that they're cutting rates, and they're cutting rates against a backdrop that is not recessionary. They're cutting rates to get ahead of the curve and support and secure that soft landing. That really does allow EM central banks and global central banks really across the world to join in that easing train. You know, easing is coming soon to a central bank close to you, and that is going to ultimately limit the extent of dollar weakness that you see. What is also going to limit it is that ultimately we expect the U.S. economy to continue to expand, to continue to grow with solid momentum. And actually some of the activity data in Europe, in China, are not that strong. China's stimulus is very different from the U.S.'s stimulus. The U.S. cuts came to secure the soft landing. The China announcements came in response to some really poor set of data. So I think we'll have to see how much traction they have, how much the economy is supported. But I still don't think we are in a zone where we should be arguing for aggressive dollar depreciation. That's not our view.
I have to say, Kamaksha, you were listening to a 1960s soundtrack when you were writing this piece. Is the first cut the deepest? And slow down, you move too fast, Cat Stevens. And of course, Simon and Garfunkel. I'm wondering, when you say is the first cut the deepest, which set me off on a sort of humming sphere this morning, I do wonder, do you think that that is the case? Or is your sort of, the dollar can't get that much more weak, predicated on the idea that you could see ongoing 50 basis point rate cuts, at least in the next 6 months?
We put a lot of effort into our titles. I'm glad you enjoyed those. But, you know, I think, yes, I think that, you know, we're coming, I think, to the limits of how much the dollar can weaken just by the Fed easing. A lot of easing is now in the price in the Fed curve. I think, you know, the baton is going to be passed to other central banks, to the economic developments across the rest of the world. Ultimately, look, I think if we're in a world where, you know, global growth is okay, the Fed is cutting aggressively, and equity markets hold up, that's a generally dollar weakening environment. But we've always maintained that the dollar's high valuation is ultimately a feature of the strong growth in the U.S. and the real returns you get in U.S. assets. We don't think that picture is going to change anytime soon, and therefore we think the dollar's high valuation will erode only very gradually.
You say a key event risk is the election, obviously, for Asian currencies. Which are the most vulnerable potentially to Trump tariffs?
Yeah, I think, look, I think if we have a set of tariffs, if we have, you know, trade disruptions, that's never good for any emerging market or any market really, which is plugged into the global trading cycle. And a lot of EMs, you know, have that exposure to global trade. You know, I think, you know, if I think of open economies like the Korean won, but even sort of neighboring economies like the Mexican peso, I think, you know, those are the kinds of currencies that could be affected. You know, China is another one where, you know, there's lots of, you know, talk of tariffs, and we saw those implemented in 2018 and 2019, and there was an impact. So I think it's the I would say open economies of Asia that are more plugged into the global trade cycle, but then also perhaps, you know, Mexico is one which always features on the top of the list, just given its exposure to U.S. trade.
We'll talk more about that next time. A clinic from you, as always, Kamak Trivedi of Goldman Sachs there on the latest out of China and the United States. And on the trade front, I think the Chinese story well understood at this point, for the former president at least. What is less understood is what happens with Mexico. I'm absolutely fascinated to see what happens in that part of the world.
What do friends mean? If you talk about friend shoring, who's a friend? And how reliable is that friendship? Can it be depended upon? And those are real questions that need to be answered.
He said goodbye to NAFTA. Does this mean we're potentially entering a Trump 2.0, saying goodbye to the deal USMCA, which he negotiated?
Feels that way. Really does feel that way. Coming up next on the programme, Stuart Kaiser of Citi, Ed Mills of Raymond James, Lord John Brown of Beyond Net Zero, and Jill Carey Hall of Bank of America. From New York, this is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
To succeed in Wall Street, what skills do you need? You need to be somebody that claws people on the back, people that you have to be tough, you have to be fighting people all the time. What are the skills that really take to succeed in Wall Street?
Great question. Of course, you have to work hard. So I can tell you what I found for me, and it's probably counterintuitive. I had to stick out, which is interesting because I made the decision earlier. Being really the only woman, I already stuck out, and I thought I might as well double down on that. I can't hide. So how did I do that? It was by being a contrarian. And I refused as a research analyst to ever publish research reports that said me too. That said, oh, IBM reported earnings. They came in 2 cents ahead. One of the pennies was currency, the other penny was lower G&A, blah, blah. Forget it. Big calls on big stocks. My very first piece of research I published was very negative at a time nobody did it. I stood the heck out. And when I was right, that elevated me. And David, I've done that as a research analyst, but I did it in business as well. Here's a business strategy. If everything's fine, just keep your head down and execute. Every once in a while, you have a big insight, and you can build an entire business, in fact, an entire industry around it.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week More than what you need to know, it's what you need to think about.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
The economy is really fundamentally in a pretty good spot, and therefore the stock market should be in a pretty good spot.
We do see momentum in terms of growth. We see momentum in terms of the earnings expectations.
At some point, the market's going to go back to a world where good news is bad news.
The most bearish thing you could say is that everybody's bullish right now.
I'm still in the roaring 2020s camp. This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The depth of Lisa's knowledge. First Color's the deepest, not Rod Stewart. He just sang it.
He did.
Cat Stevens wrote it. Did not know that.
1967, the same year that actually Feeling Groovy was released, which is the other song in there. I went down a real rabbit hole.
Are you going to tell us some market stories about that particular year, or we're not going that far just yet?
1967. I haven't checked the bond yield perspective during that.
Check where the 10-year bond yield was back then.
Carry on.
Let's get to equity markets. Let's start there. Yesterday, the 40th all-time high close on the S&P 500 of the year so far. We add just a little bit of weight to it. On the S&P right now, up by 0.06%. On the NASDAQ, up by 0.2, just a little bit of outperformance on the Russell, and by 0.25%. The news overnight out of China, cutting interest rates, reducing reserve requirements, studying setting up a market stabilization fund, and a whole lot more, sending Chinese equities up by more than 4%.
This is the beginning, and I think a lot of people would agree that this is a first step as you do see deflation, outright deflation in China, and you have a real question about how you get consumers to spend more, how you get the labor market to improve. Key question is, this obviously isn't being treated as a bazooka, because otherwise you'd be seeing a bigger response in markets that have really responded to any kind of Chinese growth. Is this really the opening salvo, or is this it? And that, I think, is the question.
Our Bloomberg Economics China economist says this will be a day to remember for China's monetary policy, because the PBOC unleashed a barrage of measures. But the issue is, of course, can this really lift consumers if they're not spending? They are not spending, and there's potentially layoffs down the road.
Those measures coming almost a week after the Federal Reserve decided to cut interest rates by 50 basis points. There is an easing mix worldwide right now. A little bit later on, there's one central banker to look out for. This central banker responsible for the first governor to dissent on the FOMC in almost 20 years, Governor Mickey Bowman, a little bit later on.
How concerned is she about inflation? Is this actually a real concern, or is it just on the margins? She still sees it as a dual mandate Fed, where you do have to watch some of the price pressures out there. How much was this orchestrated? I know this is kind of conspiracy theory.
Orchestrated dissent?
Yes. I mean, this is perfect. It's a perfect way of signaling that this isn't necessarily all holds barred, we're going to slash it to zero. It's a good way to say, look, this time is different. The first cut is the deepest.
You'd really like to have been on that FOMC meeting on Wednesday, wouldn't you?
I'd like to be invited next time. Yes, please. Yeah. I'm available. I won't say anything.
What are you suggesting happened? That they needed some cover to go 50?
Well, it's a signaling device. If you basically say, this is the first time going back, I believe, since 2005, that you have a dissent from a Fed governor, look, this is different. This is something where we're having a robust conversation. We're not sure what the right path to go is, but we made a mistake. We should have cut in July, so we're adding another 25 basis points, and here we are. And it's a signaling device, more say, than, oh my goodness, we all hate each other. This is going to be really violent next time.
There's some convenient dissents on the FOMC. Your equity market looks like this, just about turning over to unchanged on the S&P 500. In the bond market for a 6th consecutive session, yields are higher on a 10-year by 3 or 4 basis points. The 10-year approaching 380 at 378.30.
I just would like to point out on Thursday we've got a 7-year auction. It's $44 billion. And as much as we like to joke about the auctions, it actually is significant, because if you start to get something sloppy around the edges, and 7-year note auctions tend to be sloppy, do you start to get a bigger push up in yield? And then what is the correlation between bond yields right now and stock valuations? I don't know that we have a clear sense of just how correlated those two are right now.
The good news is starting to become bad news again. Is that where you're going?
I think that let's park that. I think my mind is just
you
spinning.
kind of went there. Good news equals higher yields, and ultimately you're suggesting that might be bad news.
Well, it might be on the edge of inflationary, at least in the bond market, or on the edge of risk premium increasing.
10-year, 378.30. We'll come back to that story in just a moment. Coming up this hour, Stuart Kaiser of Citi, as Fed officials leave the door open to another large interest rate cut. Lord John Brown of Beyond Net Zero on AI's big energy demands, and Jill Carey-Hall of Bank of America on why she's cautious on small caps. We begin the hour with stocks at record highs after a handful of Fed officials said additional interest rate cuts might be on the table. Stuart Kaiser of Citi writing the following. Looking ahead, we think the equity response to rate cuts will largely depend on the labour market data. Getting an early start helps, but if labour markets keep correcting, then rate cuts will not be enough to offset recession risks and equities will move lower. Stuart's with us in the studio here in New York. Stuart, good morning to you.
Good morning.
Has anything changed? Did we learn anything last week? Did we settle anything at all?
I mean, we settled the fact that they're indeed, starting to cut rates. I think, they were very clear about, dual mandate conversation. But I think, to be fair, they started that migration of the dual mandate back last December. And I think really what they're telling you now is the dual mandate probably, is tilted towards the growth side of things. And they, quote unquote, don't want to fall behind. And the market is, I think, taking their word for that this is, sort of not a preemptive cut, but an insurance cut to get themselves back closer to neutral in case, they see a deceleration in growth. But as you read before, I mean, our view is if you get that deceleration in growth, 50 basis points isn't going to be enough to help.
And to put it another way, then, if we get more big interest rate cuts, but they're justified by weaker economic data, it's harder to be bullish?
Oh, 100%, 100%. I think if they're able to gradually get themselves back towards neutral and you get, let's say, payroll stabilizing around 150K, extremely positive, kind of situation for equity markets. But if you get payrolls falling and it looks like they're under pressure to catch up, then I think that is negative for equity risk reward. And that's kind of where we've been.
Which raises a question. Are lower yields better for stocks, or are lower yields probably worse for stocks? Because essentially that means that there's a bigger problem. How do you sort of parse that at a time where we don't really know what neutral is? We don't really know what rate we're heading to?
Look, I think you hit on it earlier. Our view, the shift in 2s, 10s back to being upward sloping is extremely important. And I think that tells you that the relationship between bonds and equities could be kind of undergoing a shift right now, right? So if you start with the supposition that an inverted curve is a recession signal, right, which is what we had, well, what do you want if you're worried about recession? You want lower yields. You want that curve to kind of steepen out. Once you normalize the yield curve, in theory, that would mean recession risks have eased, right? So in that case, we actually think you're going to want higher yields at the 10-year point because that 10-year point of the curve is more growth sensitive. That's like your growth impulse. So it's early stages. We've just kind of broken that inversion, but I do think it shouldn't go like, we shouldn't ignore the fact that that shift in the yield curve is meaningful, and the correlation between bonds and equities could definitely be kind of in a paradigm shift right now.
Which raises the question, is the bar for good news higher right now for stocks, given where valuations are and given that they won't necessarily get a boost from lower yields?
Yeah, look, that's a tough question. I do think at this point, frankly, if you printed 150, 160K jobs, I think that would be, red positive and the market would respond. I think if you have a Fed that is worried about slowing growth and is cutting rates to deal with that, that actually kind of lowers the bar for good news, I think, because the market is going to take positive news on ISM, on claims, on payrolls, more positively than it otherwise would have. I mean, if I told you we were going to print 150K payrolls in June, you would have thought that was negative. We print 150K payrolls next week. You say, oh, that's not so bad because we're at 50K and they're doing insurance cuts. So I do think the bar is actually a little lower for news right now.
Do you think the policy growth mix right now justifies a shift to small caps?
It 100% depends on the labor market. As we've been saying that small cap trade is very tactical. It's trading. It's very hard to be buying sort of a rate sensitive, growth sensitive asset into what is potentially the early stages of a deceleration in growth. So I think you can be long small cap ahead of catalysts where you have some confidence you're going to get good news. But I think that's just a really hard trade to hold in your portfolio over a 3 to 6 month period.
Speaking of really hard trades, utilities, just phenomenal, the performance so far year today. It's been really difficult for us to try and work out whether that's just a pure bond proxy, defensive, or something else linked to AI. What is it?
The bond market is helping, but I think a lot of this has to do with, we're going to reopen 3 Mile Island. I mean, that's like a headline in my lifetime you would not have expected to kind of hear that. So I think honestly, look, I think the lower yields helps. It kind of puts it a little bit back in the spotlight, but I think what's driving the kind of sort of convexity or acceleration you're seeing is much more
So just quickly, high yields don't hurt it? Because we're getting high yields over the last 6 days on a 10-year, and I'm wondering if that continues, whether that trade is facing a real headwind.
Yeah, I mean, higher yields probably don't hurt it as much as they would under normal conditions. I think the market is viewed as the Fed's cutting, so that's a lower yield environment. That's incrementally positive for utilities, plus which I can bolt on this really strong thematic that, hits a nice AI hashtag, and I think that combination's really helped.
In your latest note, you talk about how there's a lot of questions regarding the U.S. election. Has any events that happened recently shifted you one way or the other?
Look, the polling has shifted. Our view has been this is 50-50. And that was our view in June, July, and even August. So I think you just have to go into it that it's basically a 50-50 toss-up and trade it that way. What is the number? You think Democrats need to poll, 3 to 5% above GOP nationally to really be confident in that outcome? We are starting to get to those levels. So I think markets are asking the question about, odds of a Harris win.
But national polls don't really matter if it's just going to be one in a swing state.
No, I agree. And that's why we view it as 50-50. Even when Trump was way ahead in the polls, in July, our view was this is a small number of states, a very narrow vote margin. It really depends on turnout. And for that reason, I think it's very hard to have conviction in either direction about which party is going to win. So I think you trade this really from a volatility perspective as opposed to directionally, at least in our view.
There was a quote that I saw this morning from Bank of America derivative strategists. With the Fed's 50 basis point cut communicating confidence that inflation is under control, the Fed put us back with a strike price as high as it's been since COVID. Are you ratcheting up your expectations of how much the S&P can rally just on a base case that the bar is a lot lower for good news for equity markets to do really well?
Look, I think there's the Uber bull case, I think, for all of this year has been you avoid a recession, you get insurance cuts, right? And that is now a plausible scenario, right? We're getting the insurance cuts. So the question is, do you get that solid labor market kind of holding in? If that's the case, yeah, then I think equity markets can go significantly higher.
What does that mean, significantly higher?
I don't know, 5 to 10% higher by year end. Something like that. If you're printing 150 to 200K jobs, that's not a forecast, just a scenario, and you're cutting 125 basis points, let's say, before the end of the year, equities are going to rally, and small cap is going to have a huge push behind it. But our view is risk reward is tough because it's really dependent on month to month. What does that kind of payrolls number look like? Fed put, yes, I get it, but if you are in a situation where you're printing recessionary labor market data, we can blow through a Fed put, no problem. We always get quoted the idea of, well, in the early 90s, we had this nice shallow recession, equity markets did well. In the early 90s, you printed negative payrolls for 11 consecutive months, averaging 145K. You lost 1.5 million jobs. The Fed put's not going to protect you if you get that kind of data. And that's why we think the risk reward is kind of a little bit off right now.
What's the number one trade you're recommending to clients right now?
Yeah, honestly, we like kind of a little bit what's worked this year, which is being in sort of your higher quality, safer balance sheet stock. And if you're worried about this bull case scenario, which people are chasing a little bit, then you own call options on the IWM to kind of hedge that short beta risk. But as we've been saying probably since, mid-July or so, the risk reward here is really challenging. We don't think it's a good time to be sticking your neck out. You kind of keep a core, higher quality portfolio. And if you're worried about it running away with volatility collapsing the way it has, you can layer that on top.
There's a phrase I've heard 1 million times over the last 12 months, price for perfection. In fact, I make a series of notes on what guests tell us every single day. And if I put into my inbox price for perfection, every single month that quote will come up. And I can attribute it to someone on Wall Street. Do you get nervous when people keep saying the same thing and this market keeps going higher?
Yeah, I guess, but there's been skeptics about this rally for 18 months, right? There's been bears on a recessionary bear case, and there's been an equity bear case, and it sort of hasn't played out. What I think was interesting from a pricing perspective last week is that yields were higher last week, right? The 2-year point was higher week on week. The 10-year point was higher week on week, and equities still move. So is that price to perfection? I don't know. I mean, the bond market is telling you this was an as expected outcome. Equities got sort of a modest rally, and you got some rotation into cyclicals. Valuation's high, yeah. I mean, there's no doubt about that. But look, we're generating the earnings growth. Look at S&P equal weight in the third quarter. Extremely positive performance because that earnings growth is starting to kind of broaden out. So I don't know about price for perfection, just in the sense that you talk to a lot of clients and there are people worried about the bear cases. So it doesn't feel like everybody's kind of all in on this trade, but I think the plurality of outcomes is soft landing. And in that sense, I think that's what people are talking about when they talk about price for perfection.
That's where I was going to go. And just to sort of put a bow on all of this, what would you have to see to go all in on small caps?
All in on small caps? It's just payrolls. If you're printing... print me 175K payrolls for a couple months in a row, and small cap is going to do exceptionally well. I mean, the biggest takeaway to me out of last quarter's earnings was the 493 in the S&P positive year-on-year EPS growth. And we were way early on that view and got it wrong. But at the beginning of the year, the idea was to broaden out performance, you need to broaden out earnings. We're finally now in the second or third quarter, seeing a broadening out in EPS. That should be very positive for small cap equities, but it's just really hard to buy it if you think recession risks are rising. So it's labor market data. I'm sorry, I'm a broken record on that one, but that's kind of how we're viewing things.
You're consistent. We appreciate it. Thank you, sir. Stuart Kaiser there on the latest. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira Hackers. Hey, Yahira.
Hi, John. Elon Musk is offering high praise for Italian Prime Minister Giorgia Meloni. Speaking at an awards ceremony in New York last night, Musk called Italy's right-wing leader authentic, honest, and truthful, adding, "That can't always be said about politicians." The remarks showing the close relationship between Musk and Meloni, whose political roots on the right align her with Trump, though she's refrained from backing him, saying she will work closely with whoever occupies the White House. The CEO of Novo Nordisk will be grilled on Capitol Hill today about the price of its weight loss drugs, Wegovy and Ozempic. The company is facing increasing pressure to make the medicines more affordable. In written testimony seen by Bloomberg, the CEO will blame middlemen, saying the company only retains a fraction of its drug list prices, with the rest paid to companies that manage pharmacy benefits for insurers and employers. And the Phillies clinched their first division title in 13 years in a big win over the Chicago Cubs, and they did it in front of a sellout crowd in South Philadelphia. Home runs from Kyle Schwarber and JT Realmuto, along with a strong start from Aaron Nola, helped seal the victory. The Phillies currently have the second best record in the National League behind the Dodgers and look to shore up a first-round bye in the postseason. That's your Bloomberg Brief. John?
Yahira, thank you. Where did this story come from? Is there a Phillies fan in the control room? Do we know that? Where's this come from?
I don't know. I really can't tell you. I know that the Mets game is very much watched at home, and I do know that the Mets are doing really well. They're in prime wild card season. I'm really crushing it.
Okay, good. Some bias going on here. We'll get to the bottom of it. Futures negative by 1/10% on the S&P. Up next, opposing policy plans.
We will tax capital gains at a rate that rewards investment in America's innovators, founders, and small businesses.
We will end all taxes on overtime.
That conversation just around the corner, live from New York City. Good morning.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
So stocks were positive. They're just turning just a little bit lower. No drama. We're down by 0.04% on the S&P. One thing that is sticking, the shift higher in bond yields, up by 4 basis points on a 10-year, just short of 380, 378.68. Under surveillance this morning, opposing policy plans.
We will pass a middle-class tax cut that will benefit more than 100 million Americans.
What I'm going to do is something that nobody's ever even thought about doing. No tax on tips.
We will tax capital gains at a rate that rewards investment in America's innovators, founders, and small businesses.
I want to cut taxes on Americans while putting tariffs on China and foreign countries.
My plan is to give a $50,000 tax deduction to start-up small businesses.
We will end all taxes on overtime.
So here's the latest this morning. Donald Trump and Kamala Harris set to roll out their new details of their new economic policies during swing state campaign events. Sources telling Bloomberg that Trump plans to offer incentives to lure foreign companies to the U.S., with Harris slated to announce new policy details in Pittsburgh. Ed Mills of Raymond James writing, the race for the White House remains too close to call. If Harris can keep her momentum, she wins. If Trump has a late surge like 2016 and 2020, he wins. Ed joins us now for more. Ed, let's talk about that late surge. Where would that late surge for Donald Trump come from?
I think his base coming home. When you look at 2016 and you compare it to 2020, Donald Trump had 10 million more Americans vote for him in 2020 than he did in 2016. He increased his vote share by 15%. If you have a surge in terms of voter turnout towards him, that especially where things are so close in Sunbelt states, he has multiple paths to 270 electoral college votes. So that's where we don't call this election just yet in either direction, John.
But Ed, has his base left him? You say they're coming home. Isn't this the moment where he needs to be catering to the center?
I don't see his base having left him. I look at polls that ask the question on a scale of 0 to 10, how likely are you vote for the other candidate? And it was exactly the same that had 0% for Biden as it has 0% for Harris, which shows me basically Donald Trump's base has held. There is a large group of Americans who have made their mind that they are not going to vote for the other candidate. When you actually add up the zeros for Trump and the zeros for Harris, it's about 86% of Americans have already decided they could never vote for the other candidate.
When it comes to the rest of the campaign trail, 40 some odd days to Election Day, Trump is almost everywhere, every single day. Even this weekend, he's going to a Georgia-Alabama game. When you have Kamala Harris doing specific events, they're very judicious in their time. Are both of these working for each candidate?
I think it's a little bit too early to tell, Anne-Marie. One thing that has been striking to me is that when you look at the fundraising numbers and you look at the spending numbers, right now Donald Trump is being outspent by the Harris campaign by about $5 million a day. And so when you are being outspent by $5 million a day, you need earned media. And you're going to need to say things that get you onto the nightly news, get you into the conversation. And so with the 40 odd days that we have left in this campaign, I fully expect that the earned media efforts of Donald Trump to ramp up, and the conversations we have out of that getting more and more kind of interesting in these last 40 days.
And I gotta say, if I'm gonna sum up both of their plans for the economy, for Trump, it's nobody pays taxes, and for Kamala Harris, everyone gets something, and both of them seem to like crypto. What's sticking with potential voters?
Yeah, I mean, who says there's no policy plans that are out there? We saw a pretty robust discussion there. What's so fascinating about this is that it's trying out policy plan after policy plan to see what actually sticks, what gets traction. On no tax on tips, you know, certainly Trump said it first, and then Harris was asked about it, and it's like, yeah, sure, let's do that, because there is a state of Nevada who a lot of taxed individuals on tips and trying to kind of win over kind of that 1 or 2% that could decide this election. What's also interesting to me is that, well, we kind of joke a little bit about how loosey-goosey some of these policy details are. we have a tax deadline next year. Something has to happen next year on taxes. So it's a very serious conversation that is going to occur in Washington, D.C. next year. $5 to $10 trillion sway in one direction or another in terms of taxes on the American people and revenues to the federal government, depending upon who wins. But we are almost in a kind of a choose your own adventure mode from the candidates as they announce what plans they have, trying to see if it kind of wins over that kind of 14% that have not made up their mind.
And I'm glad you went there. It's an important point, especially ahead of December, when a number of people are wondering whether to sell and get ahead of some increases potentially on capital gains taxes next year. How much, when you talk to clients, are they watching the polls and, depending on who's ahead, deciding whether or not to sell for the tax loss purposes?
Not yet. There's been a little bit of a conversation of it's been unusual that after the first debate, we clearly saw the Trump trade getting put on. After the second debate, we had the Harris trade being put on. A debate that I've had with clients is, do you want to get ahead of that, and does November 5th become a sell the news event? Beyond that, if you do have a Harris victory on capital gains for individuals above $1 million, she's proposed a 28% level. That is going to potentially have some tax loss or tax prevention harvesting come December if she were to win and there was a Democratic sweep. Because arguably, probably the only way in that happens is a Democratic sweep. So that's one of the risks there. But if it is a split Congress, there's no expectation. And obviously, if there's a Republican sweep, we're not going to see those increases on capital gains. But we probably also don't see all of the tax cuts that Donald Trump has proposed. I think what he's doing is trying to move the goalpost. So having the extension of what he did in 2017 as the compromise victory as the base case.
Ed Mills, we've got to leave it there. Thank you, Ed. Ed Mills of Raymond James. A big weekend of campaigning coming right up. For those of you outside of the United States, it doesn't get much bigger in SEC football than Alabama, Georgia. For college football, TV ratings through the roof. There's going to be a lot of people, a lot of eyeballs on that event on Saturday.
Well, to Ed's point, it's because Harris is outspending Trump $5 million a day. And he is oversaturated right now. She's underexposed, but he has to be because he needs that free media.
That's one for the weekend. Coming up on this program, imagine restarting a nuclear plant and then basically selling all the output to Microsoft. That's what's happening in this country. Lord John Brown of Beyond Net Zero as AI drives increased energy demand. From New York, this is Bloomberg.
Welcome to the world of of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people,
The tectonic shift emanating from Washington. It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
the transactions,
Really a record-breaking moment. Crypto VC is back.
and the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
2 hours away from the opening bell, equity futures just about positive on the S&P 500, a lift on the Nasdaq 100 up by 0.05. The gains stick, they hold on the Russell, the small caps up by 0.2%. If you are just joining us this morning, lots of changes overnight out of China, lots of move. They've cut interest rates, reduced the reserve requirements for banks. They're studying setting up a market stabilization fund as well. There's a lot of other initiatives in the mix about buying second homes, et cetera, the kind of things we've been talking about for quite a while.
And two-year yields in China did fall to an all-time low overnight in response to this. You're not seeing a massive read-through in terms of a global equity rally. What you do see is that maybe the Fed's rate cuts are paving the way for further easing in other economies that might need the stimulus a bit more.
We certainly saw a rally over in China, the CSI 300 with its best day since 2020, up by more than 4%. No big follow-through to the US session, as Lisa indicated. If you switch on the board and turn the page, we'll get to the bond market story. Yields are higher by a single basis point at the front end. All eyes over the last week at the longer end, the 10-year. Yield shifting higher for a sixth consecutive session, up by 4 basis points on a session, Lisa, getting closer and closer to 380.
A real question of how you price faster growth. If the Federal Reserve does try to get ahead of any potential weakening, then you would have to imagine on the flip side, you would see maybe, I don't know, inflationary light on the other side that could come to the fore. Hard to really put too much into the moves yet, though.
If we talk about Europe, the euro just a little bit stronger, 111.26. German business confidence out early this morning. Not great. We weren't looking for it to be great. It was even worse. German business confidence, just part of the broader story over in Germany right now. That economy is in a soft spot, and it's looking for a positive catalyst.
I'm curious to see if you do get more ECB rate cut expectations, and there are some now saying that they are going to cut rates more aggressively. Does that help the euro, or does that hurt the euro? At what point are we talking about growth differentials more than interest rate differentials? And that is, I think, the next maybe leg of this story.
That's definitely been a big part of the conversation over the past week. We've focused on Federal Reserve interest rates normalizing somewhat. Can growth differentials rebalance? You'd have to think that China's a big piece of that puzzle right now. And if they can get some traction in that economy, it should go downstream to places like Europe.
Which is the reason why you can take a look at the euro strength and talk about more what happened in China than, say, German business confidence, which isn't there.
And the rally, if you look at the chart, speaks to exactly what Lisa just described. Euro dollar right now, 111.26. Under surveillance this morning, Israel carrying out its deadliest airstrikes on Lebanon since 2006. Lebanese officials saying nearly 500 people were killed in the attacks.
It's getting very difficult right now in the Middle East by the hour. You had one Israeli military official coming out yesterday, so saying basically they want to degrade Hezbollah's military capability in the air. But the question remains, would we potentially see a ground invasion? On top of that, we're going to hear from President Biden today, speaking at the UN General Assembly. It just strikes me how different his tone is going to be today when it comes to the Middle East. The DOD is preparing to send more U.S. men and women to the region This time last year, when I was with Biden at the UN, he was talking about a new Middle East, an integrated Middle East. Very different story today.
Right now, based on the headlines, the imagery that we see, it is surprising that the market is not treating this as a real event. And that, to me, is sort of a key question. When do we start to see more of a market response to it? Halima Croft raising that for RBC. And I think that increasingly should be a question as we look at escalation and the potential outcomes there.
Brent crude this morning on the session up by 2.4%, 75.67. Let's talk about Boeing making an offer to striking union workers, including a 30% pay bump. The plane maker looking to resolve the strike, which has shut down factories across the Pacific Northwest for over a week. Union members are still pushing for a 40% pay increase.
With the union leaders saying they're not even going to bring this to the rest of their members until it's something more in line with what they would like and what they've been asking for. Real question here about what's going to give for Boeing. It's sort of a situation that keeps getting worse. Where do they get the money to really make good on some of this?
And when you look at how Boeing put this out, they put it on their website in all caps. It said best and final. And the union is saying we're not even going to vote for it. How much more can this really go down to the wire? Because they've come up from 25 to 30%. But the union's saying we want 40.
Is it truly best and final? And a final story for you. The DOJ planning to slap Visa with a lawsuit alleging the company illegally monopolized the US debit card market. Sources telling us here at Bloomberg that the DOJ is accusing Visa of preventing competition through exclusive agreements to weaken competing payment networks. That stock is down more than 2%.
When you read the details of this, it's actually really fascinating. The tokenization of everybody's credit card numbers to prevent theft, to have certain security, to protect identities, and basically they will charge, Visa charges a lower rate to vendors who use this tokenization, but then they have to only use Visa. So it locks out other potential competitors. And this sort of becomes a real issue because Visa can say, look, this makes our business more streamlined and cheaper. But on the flip side, it really sort of raises the barrier to entry for others as well.
The Federal Trade Commission last year reached an agreement with MasterCard. And I imagine potentially that lays the groundwork, what we could potentially see happen with Visa.
That's the latest on Visa. Let's get to a big story in the last few days in this country. The rise of artificial intelligence fueling energy demand across the nation's power grid. Constellation striking a deal with Microsoft to restart the 3 Mile Island nuclear power plant by 2028. Former BP CEO and co-founder of Beyond Net Zero, Lord John Brown, joins us now. Beyond Net Zero is responsible for General Atlantic's climate growth equity strategy. John, it's fantastic to see you, sir. Thanks for being here.
Good to be here.
It's amazing what's happening in this country. To see a nuclear plant be reactivated, restarted to supply energy to a tech firm. How big is the scramble for energy in this country?
It's very big. For electricity to power data centers, which are being built globally at a rate of 1 a day, and they're very big ones, it's very fast, you know. So a very big data center nowadays probably can absorb 1 nuclear core. You know, about 600 to 800 megawatts. So it's better to restart and reuse a nuclear power station than build a new one, but we're going to have to build some new ones until there's a reaction. And the reaction is, how do you actually reduce the power consumption of AI? I think the answer lies in the fact that there are 2 different things going on here. One is training, which takes a lot of power. I know that from some of our companies, very expensive. And then inference, which is what you do to use it, takes much less power. So people are working on different chips, different data centers. And so one day this will probably flatten out a bit. But right now, it's a lot.
The big picture, do you think it undermines some of the climate goals we have in this country?
Not necessarily. You know, first of all, we have to think about not just this country, but the world. So it's a contribution to this country. There will be ways of offsetting it, and there are ways of getting renewable energy to data centers. So it's a mix of things. There's no one solution to this.
John, this is the reason why I was excited to talk to you more than anything. I was looking for some optimism, because usually when you talk about climate change, you hear gloom and doom and sort of existential angst. You said that nearly 80% of the technologies that we need to reach net zero by 2050 are already developed. The issue is just capital investment. Can you explain?
Well, it's also capital investment and cost. Cost and capital investment go hand in hand. The more you do of something, the cheaper it becomes. So you've got to get started, and you've got to figure out how to get some form of incentive to get early technologies applied. I remain very optimistic. I do think our biggest problem is we've spent probably a quarter century discussing the problem and doing little about it, and actually arguing whether there's a problem at all. So we've got about a quarter of a century of time to make up. So we've got to speed up, which means we need much more money going into growing the things that we know that will work. And that requires us to have the right incentives in place, such as a price for carbon.
Okay, what are the right things that could work? Because we know that just telling people, you know, be better about throwing out fewer items, or, you know, don't use plastic bottles, or some of these sort of lifestyle changes are not working. They are not resting with people. In fact, they are actually causing people to reject it. So what are the things that are actually working?
So the very big thing, which has to work, is not quite working yet, is how do you take carbon out of hydrocarbons? Because we're going to use hydrocarbons for a long time. And so capturing carbon dioxide and storing it away in different ways, not just the old ways that people are thinking look like big refineries, but there are more sophisticated ways, I think, being developed. That's the very big thing to crack. The second thing to crack is how do you actually use energy? And part of that is energy efficiency, part of it's the circular economy. You know, what you do with the old tires, for example, you know, on a very big scale. It's doing big things, and then finally it's creating new energy. I was in India just a few days ago, where I was seeing a huge rollout of, you know, solar plants and wind plants, up to 500 gigawatts. Huge amount will be in place in 20 years' time, and it's moving today,
John, do you think policy intervention works?
It has to work. Energy is, the whole energy scene, in my experience, is founded on good policy. You know, there's nothing natural about it, so the government has to both inspire and avoid the use of energy. So taxes are important, but the key is getting them stable and keeping them in place all the time. In the end, it's, you know, if we'd stop people putting carbon in the atmosphere, we have to charge them for doing it. And stuff about carbon border adjustment mechanisms, all of these things are designed to do just that.
I look at the IRA, though, and parts of it, some people say, did work, but other parts, things like public charging stations, I think they have about 24. They're spending billions of dollars on this. Should this not be left up to capital markets?
Absolutely, and you know, there are things that misfire in all policy. I think one has to be very careful in all these areas of big change during the transition, not, if I can use the old phrase, make perfection the enemy of the good. You know, we've got to get on with these things. It's like carbon markets, you know, they don't work. But they never work until you start them. And so you've got to do a bit and then correct. It was the same when I was, you know, in the bond markets 40, 50 years ago. They didn't really work properly. But look at today. So I think I'm optimistic as long as we just keep pushing ahead and don't allow ourselves to be blindsided by the small. Look at the big picture, which is we've got to get rid of carbon dioxide. Very simple, and we've got to do it quickly.
We had, just to jump in, forgive me, we had a guest on the program yesterday who said we've managed to reduce our reliance on OPEC, but we've increased our reliance on China when it comes to renewables. Now, when you were the CEO of BP, we were producing something like 6 million barrels of oil a day in this country. It's now 13. We've managed to reduce our reliance on OPEC. Can we do the same thing with renewables with China in the same way we did with OPEC and fossil fuels?
Of course. That's, again, I come back to my experience in India a few days ago. I went to a wind farm. 100% of it was built and sourced in India. It wasn't imported from somewhere. So if it can be done in one place, it can be done in another. You know, trade barriers used to be regarded as somewhat economically inefficient, but they are what they are, and you can get things done.
What are you investing in with regards to that effort right now?
So we're doing a lot on energy efficiency and energy effectiveness, circular economy. You know, how do you measure things to get more efficient, whether it's supply chains or whether it's you know, how people think about their own carbon reductions. So a lot of things like that. We're investing in sub-Saharan Africa. We're investing in India, a variety of things like that.
The difficult part about this is seeing the investment make a lot of money at a time where you're reliant on incentives to make something work? How much is that sort of part of the calculus that, you know, you have to sort of suspend or just have faith that there will be the right policy mix to make some of these companies viable?
So I regard all taxation policy as incentives, all of them. And we don't rely on things that are exceptional. We just don't. What we believe very firmly is in order to get sustainable investment, you have to beat the rest of the investment pack. So we invest, for example, for a 25% IRR, which is what we get. And you can do it. You have to be selective. You have to go to places where you know that the incentive structure is stable and makes sense. Again, I've been in plenty of areas in the past when I remember being in very close to home, Spain, where they overdid the incentives. And everybody knew they overdid the incentives, and everyone was surprised that they changed them. You can be contradictory if you want to be. But you have to be careful about that. You know.
John, always a clinic. It's good to see you. Thanks for your time, sir. Appreciate it.
Pleasure.
Lord John Brand there of Beyond Net Zero. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. U.S. President Joe Biden will deliver his final address before world leaders today at the UN General Assembly. Biden will reportedly speak to the importance of international alliances to address emerging concerns from climate change to AI. He will also call for the expansion and strengthening of institutions, including the UN Security Council, and will speak to the ongoing wars in Ukraine and the Middle East. Meanwhile, Hurricane John made landfall as a Category 3 storm on Mexico's Pacific coast last night. The National Hurricane Center issued an advisory for the state of Guerrero, warning of significant flooding and a life-threatening storm surge. Plus, the state could see as much as 30 inches of rain through Thursday. The storm coming just days before President-elect Claudia Sheinbaum is set to take office, raising the stakes for her administration to manage the crisis on her first days in office. And TikTok is discontinuing its music streaming service. In a post on its website, it said the music division said it will go offline on November 28th and customer data will be deleted. The move ends TikTok's years-long effort to capitalize on the app's popularity with music fans and compete with Spotify and Apple. That's your Bloomberg Brief. John?
Yahara, thank you. Up next, small caps betting big on the Fed's big cut.
I do love that the small caps are starting to rally. We need to see that stick, I think, for a few days, but I'm optimistic now that we might be near the end of this big rotation, or the old rotation starting a new one.
The View from Bank of America up next. Live from New York, you're watching Bloomberg TV.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, you know, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics and math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Equities just about higher by 0.1% on the S&P 500, slightly positive across the board here on the Nasdaq as well. In the bond market, yields up now by more than 4 basis points, getting closer to 380, 379.44. Under surveillance this morning, small caps betting big on the Fed's big cut.
I do love that the small caps are starting to rally. We need to see that stick, I think, for a few days, but I'm optimistic now that we might be near the end of this big rotation. There's the old rotation starting a new one. Hopefully we're in a brief period where okay news is actually good for the markets.
So here's the latest. Small cap stocks looking for a boost after the Fed's 50 basis point rate cut. Jill Carey-Hall of Bank of America saying we're still near-term cautious on small caps, given there's been no evidence of improving fundamentals. But for investors with a longer time horizon, we see better long-term return potential for small caps than large caps. Jill Carey joins us now for more. So Jill, let's split it up, time horizons. We'll do near term and then we'll get to longer term. Near term, are we saying the relief rally off the back of rate cuts is already in the rearview mirror?
I think it could be still a challenging short-term period. So I think the Fed is definitely a positive, and that was one of the reasons small caps first saw the rally in July, and now more recently as well. And this mitigates some of the concerns around refinancing risk, obviously around growth more generally. And I think that the earnings impact, when you look at it to small caps based on refinancing risk, and when you factor in what our economists are expecting for Fed cuts, that's basically half of what it would be relative to what if the Fed were not cutting at all. So definitely better for small cap earnings. But I think near term, when you think about potential for volatility to stay elevated ahead of the election, when you think about seasonality, October is usually the worst month of the year for small caps relative to large. And when you think about the profits backdrop, we haven't seen the improvement in fundamentals for small caps that we've started to see for large caps. So the profits recovery keeps getting pushed out, and now you've obviously seen some of the macro data weakening, so that calls into question whether all of the hope that's baked in for now fourth quarter, seeing profits growth turn substantially positive for small caps, whether that can still come to fruition.
Why do you believe the relative story improves the further you look out? Why does it change?
I think when you think about longer term, one of the biggest drivers for longer term index returns has been valuation. So the valuation story hasn't changed that much. Small caps are less cheap than they were a year or two ago, but still relative to large caps near historic lows, and that tends to matter for what indices do over the long run. So small caps, based on just a simple valuation framework, that would suggest small caps could see call it 9% annualized returns over the next decade versus low single-digit returns for the large caps. And I think there's a lot of positive, multi-year thematic themes that could benefit small caps. If we see a CapEx cycle in the U.S., reshoring, peak globalization, a lot of the domestic mid-cap companies could benefit from that.
Let's talk about one of those stories. You mentioned this statistic, and I thought this was fascinating. This year, private equity dollars invested in physical infrastructure is tracking 6 times the amount of money being invested in tech. Can you explain a little bit more about that statistic?
Yeah, I think we think we're going to see a real shift in how CapEx dollars are being spent. I think you've seen this massive amount of money spent on tech CapEx, while companies have underinvested in physical infrastructure structures. The infrastructure within the U.S. is very old and crumbling. You've seen more accidents, more accident-related deaths. So we think a lot of companies now, are needing to spend on, more old school, typical picks and shovels type of CapEx spending.
So how do you see that playing out in small caps, in specific sectors of industrial, smaller companies that could potentially be on the other side of that?
Yeah, we've seen that for U.S. small caps, their sales growth has been much more correlated to CapEx cycles in the U.S., particularly that, picks and shovels type of CapEx than large caps have. So they're definitely a beneficiary. And when you think about sectors, they're anything from industrials, machinery, some of your traditional sectors, materials, as well as things like industrial REITs, banks that can do lending, anything that's in some of the regions, call it the Midwest, or industrial warehouse REITs in the Sun Belt. So I think there's a lot of beneficiaries within domestic mid caps from this CapEx theme and from the reshoring of U.S. manufacturing, which we have started to see real evidence of that is happening.
A lot of equity strategy teams in the past week re-released their Federal Reserve rate cutting playbooks. you and the team did something different. There is no Fed playbook. Every cycle is different. Is there a cycle? Can you look back on a cycle in the last 50 years in a post-World War II period where maybe it's relevant to the situation we're in at the moment?
Well, I think what we have to look at right now is that, you know, if we're in an environment of lower rates, I think when you look at large cap equities in the S&P 500, dividend payout ratios have been very low. Profits are now recovering for the rest of the market. For big cap tech and Magnificent Seven, you're starting to see a slowdown, but for the rest of the market now it's picking up. So that should be positive for value stocks. You should see a shift from, you know, shorter duration assets, money market funds into equity income. That should benefit dividend stocks. We should see a recovery in dividend growth. So we think that's, you know, one important factor and how that will play out based on the Fed cuts within large caps. You know, within small caps, it's been a bit mixed. I actually see mid caps as potentially a better way, a better beneficiary and kind of a hedge near term because they're going to be less exposed to the volatility within the market, but they've actually tended to outperform pretty consistently when the Fed cuts, as well as when we're in these slowdown regimes. We have a U.S. regime indicator on the team that just moved into the downturn phase, and that's an environment where you want to tilt up the market cap spectrum, and mid caps have actually fared better than small caps in those environments.
Has your phone just been off the hook? I mean, for a while, people just were sort of leaving small caps for dead. I'm sorry, but it's sort of true. Now are people saying, okay, come on, what do I buy?
Yeah, I mean, I think in general, you know, these things run in cycles. So often when you look at secular cycles of small versus large caps, they can last almost a decade. So we were in a period where from 2014 until now, small caps were underperforming. So I think, you know, like I said, there is a very positive long-term case to be made that maybe for the next decade, this could be an outperformance cycle for small caps. Near term, definitely want to be selective. We think it makes sense to stick with higher quality stocks within small caps. Certainly equity income, as mentioned, benefits during Fed cuts. But, you know, I think there are a lot of opportunities within small caps right now where investors were very underweight this asset class after underperformance for about a decade.
Joe's phone's always ringing, Bramo. You suggesting that Joe wasn't doing anything for 10 years?
Are you kidding? Never. I would never accuse her of saying that. But you know when you just sort of are working on something for a long time and suddenly people like
Wake
realize,
up and pay attention to
yeah, and then they call you and you're like, really, now?
How you feel every time the bond market sells off?
Hey,
every time yields shift higher by 10 basis points.
Pretty much, yeah,
Told
exactly.
you.
Right? Watch the auctions.
Joe Carey Hall of Bank of America. Joe, thank you. Appreciate it. Coming up on this program in the third hour of Bloomberg Surveillance, we'll catch up with Emily Rowland of John Hancock. Bloomberg's David Welch on Tesla. We'll speak to the former Fed Governor Betsy Duke and Rob Waldner of Invesco on deficits, bond auctions, and higher bond yields. That wasn't a plan, but we can do it anyway.
Over $69 billion later today.
There you go. Makes sense. Futures on the S&P up by 0.1% from New York City this morning. Good morning.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is we built essentially from scratch, you know, with lots of supporters, a really mind-blowing level of innovation against emissions. And you know, in the last 9 years, that's gone better than I would have expected. So only now could you even, you know, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up very like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. You know, in the meantime, some people who care about this issue are really out, you know, trying to think, do we need permitting reform? You know, do we find, what new ideas haven't we found yet? You know, how do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Inflation isn't all the way there.
By cutting rates, we may actually get an accelerated decline in inflation.
We think inflation's settling now in a 2.5 to 3% range. Fed seems okay with that here.
Fed officials are just focusing on what their policy is going to do to the economy without really putting it in the context of the overall economy.
My concern is that we're just making a pit stop in this balanced level on our way to weak.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Big stimulus package out of China overnight, reducing reserve requirements, cutting interest rates, easing rules to buy homes, all kind of things coming out of there. Even studying a plan to stabilize the equity market. They did more than just stabilize the equity market overnight. That equity market absolutely ripped. The CSI 300 up by more than 4%, the best day of gains in China since 2020. The follow-through, really, really muted stateside. Equity futures up by not even 0.1% on the S&P 500. On the NASDAQ 100 up by, let's call it 0.14. On the Russell, Lisa, up by 0.2.
This is the beginning, and we've been talking about this all morning. Key question is really less for the U.S. and more for Europe in terms of the read-through for economic growth. But for the U.S., it is interesting that the Federal Reserve has cut rates and has opened up the path for other countries to also potentially provide some sort of accommodation for their economies that are actually having more difficulties in the U.S.
It is the beginning. Capital Economics this morning coming out and saying a step in the right direction, but where does it end? And when you talk to economists, you listen to all the research notes, they're all talking about the fact that this has to end with some sort of fiscal policy because offering up cheap money is not going to work. If you look at the anecdotal survey data coming out of China, people are shunning restaurants, people are shunning luxury goods. They are not buying and they are not spending.
Put the last 24 hours together. Put the last week together. We heard from Austin Goolsbee, Chicago Fed president yesterday, who suggested that maybe there was hundreds of basis points of rate cuts to go just before we even get to neutral. That's Goolsbee. How lonely is he on the FOMC? I'd suggest maybe he's not that lonely right now. Put it together with the stimulus efforts out of China. You heard from Ed Giardini of Giardini Research just moments ago. And Ed made the point yesterday there was a real risk of a melt-up in global equities. I wonder how real that risk is this morning.
Part of the reason why that's the real question, are we facing off with a melt-up or are we basically trying to cut too late at a time where there already is entrenched weakness? The reason why we don't understand that is because we still are grappling with the post-pandemic reality, and I feel like Tom Keene, and I apologize in advance, but there is this idea of where are we headed? right? We don't normally see some sort of increase in unemployment rates without a continuation of that. Honestly, you just keep talking about these bifurcated outcomes. You can get two people making cases on either side. I'll buy what they both say. It just is not clear right now.
All roads lead to the US equity market. The difference between being bullish and being bearish right now. Stuart Kaiser of Citi said the same thing in the last hour. Look ahead to payrolls, 2 Fridays away. 133 is the estimate. Stuart made the point around 150, good to go. Anywhere close to 100K, you start getting worried about that slowdown becoming a whole lot worse.
That's the gap right now to really understanding, are we on the precipice of a greater weakening that Austin Goolsbee was talking about, which it clearly is his concern, or are you looking at the issue of some sort of reacceleration in inflation, which is maybe with the bond market, maybe gold is sniffing out?
Well, they want to have a soft landing, so they need to achieve that with the labor market. When you talk about, though, potentially this 50K spread, then you look at the revisions, potentially prior months could already be there.
It's even harder than that. This comes from Seth Carpenter. Thank you, Seth, for making this really, really complex. Seth Carpenter of Morgan Stanley said the strike at Boeing, 30K, the threatened port strike, 45K, could slow payrolls. But if we get a number closer to 100K, excluding strike effects, then Powell's determination not to fall behind the curve will be brought to the fore. So we need to take 30 off for Boeing, need to take 45 for a threatened port strike, maybe, when we get this payrolls report. And then you need to subtract sort of like the overall number we subtract now every single month, which is about 60. And then if you're close to 100, we've got a problem. It's a lot to cut, isn't there?
You then have to figure out, is there a factor of companies not hiring because they don't want to make any big plans ahead of the election? Then you have to throw in potentially all other lack of responses to surveys. This is messy data.
It's a lot to unpack.
It is a lot to unpack, and it's the reason why revision suddenly might be the most important indicator, according to Jerome Powell, in terms of his speech and why he has confidence that this really is the right move.
I'll say it for Lisa, according to Lisa, and echoed by Chairman Powell in the news conference.
Thank
Fair?
you.
Fair?
I appreciate that.
I'm here to support you. That's why I'm here.
I'll let them take it. Just invite me to your meeting.
That's all you asked for.
That's all I asked for.
That's all Bramo asked for. Anne-Marie just asked for you to cite her every time you say it's the Oprah tax cut campaign. How many times have you said that?
Yeah, and Terry Haynes has cited me, but no one else has.
Good. Well, people should. Coming up on this program, we'll catch up with Emily Rowland of John Hancock as stocks return to all-time highs. Bloomberg's David Welch as analysts look for better deliveries from Tesla, and former Fed Governor Betsy Duke as several FOMC officials open the door to another big interest rate cut. We begin this hour with stocks coming off the 40th record high close of the year so far, as optimism builds around rate cuts in the US and stimulus measures in China. Emily Rowland of John Hancock saying while the risk-on environment is tempting to leverage up into, we would be mindful here that a lot of good news is being priced into riskier assets. Emily joins us for more. Emily, more good news. More good news overnight. Stimulus measures out of China. Is there a reason to buy equities this morning based on that?
I mean, look, one of the biggest risks to being underweight China and underweight emerging markets is that policymakers can come through with these big packages. I don't know if I'd necessarily call it a bazooka, and it likely needs to be followed up by more on the fiscal side. But this is creating this risk on rotation, or prompting it to continue, as we see these big moves. I think you guys have been making some great points this morning about, is this actually going to get the Chinese consumer off the sidelines? That remains to be seen. But certainly this is adding to the momentum and the sentiment that's permeating markets right now, which is that everything's pretty great.
Well, when you look at the US versus the rest of the world, does it change the story for you? Is it enough?
John, it doesn't. And it's really amazing to wake up in the morning and you see this terrible data out of Germany from the IFO to manufacturing. I mean, German manufacturing PMI is at 40 right now. That is in recessionary territory. And meanwhile, you look at the DAX and it's up 1%. So I think markets globally are really reacting to the Fed pivot, the 50 basis point cut, stimulus out of China. Again, we want to be fully invested here, but we want to be mindful of going over our skis and taking risk in a market where, I know you've been shaming everybody for saying price for perfection all morning, but it is really in the price with the S&P 500 reaching new all-time highs every day. Underneath the surface, we would suggest just being mindful of taking too much risk.
It's not shaming, Emily. We think that it's a valid phrase that sticks in our minds, which is the reason why both John and myself write it down when people say it, which is frequently. I am curious about how difficult it is to remain cautious at a time where you see so much risk on appetite and a Fed that seems to be behind part of it, at least.
It's really tough. I mean, I think, again, we are fully invested. We're buying high quality stocks and bonds, but I think the trickiest time in any economic cycle to be bearish is at the very beginning and the very end of it. And I think that's what's happening now. You know, we think about it like the music's getting turned up. At the end of every cycle, the music gets turned up as inflation comes down. The challenge is it gets really, really loud until you start to see initial jobless claims picking up and high yield bond spreads widen, and then things change quickly. They go quiet very fast. Right now, initial claims are sitting in a low 200,000 range. High yield bond spreads are 302 basis points. They actually dipped below 300 basis points after the Fed's move last week. So the music is still playing. You want to be invested. You could see markets continue to see momentum here. Again, it's just about making sure bonds are still playing a role in your portfolio and leaning into higher quality stocks and finding quality at a reasonable price in order to, you know, again, stay invested and be involved if we do see this market melt up.
Let's talk about the bond market. Bespoke Investment just put out this statistic. The 10-year yield is up every day since the Fed cut rates, rising 15 basis points in that period. How do you have conviction in a long end of the yield curve at a time where this market seems to be suggesting, hinting, flirting on the edges with this idea that potentially the more that the Fed cuts now, the more that inflation could be sticky or even pick up later?
Yeah, I don't think it's surprising to see this backup in the 10-year yield. You know, certainly the Fed supporting the economy with a larger cut is bullish. It's risk on. It's another part of the risk on puzzle here. You know, I think the biggest risk is not necessarily inflation picking up. That could be part of it, but more of a melt up in markets, which could create more leverage in the financial system if you continue to see, again, equity markets surging. You see that, you know, momentum stocks, Bitcoin, you know, low quality companies all kind of participating in this rally. Eventually, we do think that an economic contraction plays out. It may take some time here, but when you lean into higher quality bonds, you know, that are paying over 4% in yield, you can get paid to wait. I don't think that the bond market is fully sniffing out this disinflationary environment that's likely to see some type of contraction, some type of increase in the unemployment rate, and it could happen so quickly. I talked to so many investors that are waiting to take advantage of higher bond yields. They're sitting in money market accounts, and we just ran some data that suggests that investors sit in cash for way too long. In fact, they sit there until bond yields are already at basement levels, and then they move out on the curve and embrace core bonds. We don't want to wait too long in order to do that. I think getting cash on the sidelines, getting it invested in a high quality part of the bond market in the intermediate part of the curve makes a lot of sense right now.
The normalization of the yield curve will give them a little bit of a nudge. Do you think the difference between the 2 and the 10-year at 20 basis points makes a difference? Does that difference need to be larger than that?
I don't think anybody is paying much attention to the bond market right now in general, given the risk on environment that we're seeing. But I do think it's enough to start to lean into higher yielding bonds here. Again, we could continue to see some more volatility in rates. By the way, the Fed just cut amidst an environment where the economic data were pretty good. You look at things like retail sales, industrial production, regional Fed surveys. So I think we could continue to see some chop in yields as the data are still suggesting that we're chugging along right now. The U.S. economy is doing okay. It reminds me a little bit of my son's grades right now. Like, they're okay, like, but they're not great. He's still on the football team kind of thing. You know what I mean? Like, we're doing all right. And so I think you might have to wait for duration to kick in as a tailwind. But again, that income is there as you kind of embrace that patience.
Is he watching this morning?
I really hope not. I hope he's in math class.
Emily, just a final one from me. I'm not going to name who this is. I'm just going to share a quote with you. This was from earlier this year. We're priced for perfection of easier policy, continued disinflationary forces, and resilient growth versus a backdrop of US growth continuing to beat expectations. I won't name and shame anyone, because I think that reflected how a lot of people felt at the start of the year. And it's the last line there, continuing to beat expectations. Do you think we can continue to do that in the US labor market in the months to come? Because it feels like that holds the key to a lot of calls.
The labor market is a tough one. I'm going to punt on that, just because you guys mentioned before, the revisions are so critical. So I think we need to take those headline numbers with a grain of salt, focus on the revisions. But I think, you know, there's a lot of expectations going into this. What I'll say is that valuations are never a catalyst for a shift in market leadership. You've got to see something else change. You have to see the earnings backdrop change. You have to see the macro regime seeing a shift. And by the way, there's more great news. Analysts are penciling in 4% year-over-year earnings growth next quarter for the S&P 500. The bar is really low. It gets much higher from there. So in terms of beating expectations from a fundamental standpoint, yeah, I think we can do it. The bar is low. Let's enjoy it while we can.
The bar is low. Young Roland. Emily Roland of John Hancock. Thank you. Appreciate it. I hope young Roland's not watching this morning.
I hope he's in math
But
class.
he's doing okay.
You know, honestly,
okay.
Okay is okay. And he's still on the football team. Go, young Roland.
Exactly. That's winning, right? Doesn't get much better than that. Doing okay?
Yeah, well, honestly.
Don't work too hard when you're young. Save that for later in life. Got enough time to work hard.
I'm a big adherent to good enough parenting. So yes, absolutely. Amen.
what the bar is.
Endorse. Good enough.
Watching surveillance wouldn't be the worst. You could be playing video games.
There you go. Much better than video games doing this, right? I agree.
I agree.
Totally agree. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. Boeing is offering striking workers a 30% pay bump. The company said the terms are final and only valid until the end of Friday, ratcheting up pressure on workers to accept. Meanwhile, the union president saying his team was blindsided by the offer, and the union has no intention of putting it before rank-and-file members. The proposal is an improvement over the initial 25% increase workers turned down earlier this month, but still less than the 40% initially sought by the union. Snap will begin using Google's Gemini AI model to help power the chatbot on its app, Snapchat. The company has been ramping up its investments in artificial intelligence alongside peers like Meta. Snap first launched its My AI chatbot last year using generative AI models from OpenAI. But the switch to Gemini comes due to its ability to process video, audio, and text simultaneously, which are central to